Thank you so much for joining us today. My name is Sherry Babowski, and I am the Retirement Benefits Manager at the Pension Fund Office. We're really excited about our new participant portal. It launched about 2.5 weeks ago. So if you have not yet set up your individual personal account on the participant portal, you can access the portal two ways. Number one, you can scan the QR code that's on your screen right now, and that'll take you right to the registration screen. If you're not good with scanning, or maybe you're watching this on your phone and you can't actually scan the QR code, you can go to the fund office website at Carpenter Benefits. Carpenter is singular and benefits is plural, carpenterbenefits.org. And you can click on the login button on the top right of the screen, and that'll take you to the portal registration. So on the new portal, you are able to view your active health plan eligibility. If you're eligible for active medical benefits right now, you can view your medical claims and active plan disability claims. You can view active plan explanation of benefits for your claims. You can see your pension credits. We have sent you your personalized pension estimates, but if you want to play around possibly with different retirement dates, or we're going to talk about a partial lump sum option, if you want to play around with different amounts, you can actually do that yourself on the new participant portal. You can run pension estimates for any pension date you might be thinking of. Okay. Once you are a retiree receiving monthly pension payments, you will also be able to see basically like a check stub on the portal. So you'll be able to see your gross amount, what's withheld for taxes, what's withheld for medical insurance, all of those things. So we're really excited about the new portal. We hope that you will be too. And we strongly encourage you to go ahead and register. Again, if you're not a computer person, if you don't want to get into the do-it-yourself thing, the fund office staff, the retirement benefits department staff, we're certainly still here to assist you with any inquiries you have, either over the phone or even in person. The offices are open again, both the Chicago campus and the Lisle campus. So we're here for you. So today, what are we going to talk about now that we're kind of past all the housekeeping stuff? So I am going to cover briefly how you've earned your pension credit. Most of you registered here today have been carpenters for quite some time, and you're pretty familiar with how that works. We are going to go over pension calculations and payment options. In fact, that's where we're going to spend the bulk of our time today. I will also talk about disability pensions, about pre- and post-retirement death benefits. We'll talk about requirements to start your pension, both filing the paperwork and what type of work you can no longer be doing in order to start your pension. We'll talk about prohibited employment once you are retired. We'll talk a little bit about the John Hancock Supplemental Retirement Plan. And then after we've reviewed all of these pension topics, we will move on and talk about retiree health benefits. So as we talk about how your plan benefits are determined, we're going to look at a couple of slides about how you've earned your credit. We'll look at a lot of slides about your pension calculations and about your payment options. This pension credit printout shows you all of your years of credit, how much credit you have earned in each individual calendar year, and it shows you your pension credit and vesting credit totals at the bottom. This credit summary is also available on the new participant portal. So you're attending today, but if you're not yet ready to retire, maybe 6 months from now or maybe next year, you want to check in on the new portal and see how much additional credit you've picked up. So you have earned your credit by working for an employer who has a collective bargaining agreement with either the construction pension plan or the Millman pension plan. Okay, this first slide is on the construction pension plan. Pension credit is earned based on the number of hours you've earned within any given calendar year, January 1st through December 31st. So if you earn less than 250 hours, you will not earn any pension credit. 250 hours gives you a quarter for that year, 500 gives you a half, 750 gives you 3/4, and 1,000 hours gives you a full year of pension credit. Starting in 1989 for the construction pension plan, it became possible to earn a year and a quarter or a year and a half of pension credit within a single calendar year. So working 1,500 hours in a calendar year gives you a year and a quarter of pension credit, and working 1,750 hours within a calendar year gives you a year and a half of credit within a calendar year. On the Millman Fund, the structure is the same, except under the Millman Fund, there is no year and a quarter or a year and a half. Under the Millman Fund, the most you can earn within a given calendar year is 1 year of pension credit. Now, over your working career, no contributions have been required from you over and above your salary. Your employer has paid into the pension fund on your behalf. Currently, the contribution rate for the construction pension fund, the total hourly contribution rate, is $37.88. Out of that $37.88, $15.76 is paid into the construction pension fund. On the Millman side, the total hourly contribution rate currently is $18.91. And out of that $18.91, $7.77 is paid into the Millman Pension Fund. Again, by your employer over and above the wage that you get on your paycheck. So let's talk about the difference between pension credit and vesting credit. Okay. Vesting credit, in order to be vested and entitled to a pension, and that's all vesting really means, is that you've earned enough credit in order to be entitled to a pension. So the current vesting credit requirement is 5 years of vesting service, and that began in 1999. Prior to that, there were greater requirements for vesting service. So between 1976 and 1998, you needed 10 years in order to be vested. And prior to 1976, you actually needed 15 years in order to be vested in the pension program. A maximum of 1 year of vesting credit can be counted per calendar year. So if someone initially became a carpenter in 1989 or later, the extra halves and quarters on the 1.25 or the 1.50, that additional 0.25 or 0.50 on the construction plan cannot be counted toward the toward the current 5-year vesting requirements. Okay. However, those extra halves and quarters are indeed included in the pension credit calculation to determine the amount of your monthly pension benefit. In addition to vesting credit being used to determine whether or not you're vested, it also helps us determine whether or not you're eligible for retiree health care benefits, and it's going to determine how much you pay for retiree health care benefits. We have a tiered premium structure that we will talk about when we get to the health benefits. Recently, that definition was updated to call it something like eligibility credit. But for most people, the eligibility credit you need for health benefits is the same as the vesting credit total that is indicated at the bottom of your personalized A printout that was sent out to you for today's webinar. For the examples today, we are going to use the construction pension plan rules. There were 147 people registered for today, and out of that 147 people, about 8 individuals registered either strictly have Millman credit or have some combination of construction and Millman credit together. So although the examples you will see on your screen show the construction pension plan accrual rates and the construction pension plan early reduction factors when we get there, the rules surrounding each of the payment options are the same for the Millman plan. Anything that is different, I will make a point of speaking to that during my presentation. Okay. The second sheet of paper is a estimate of monthly pension benefits. You have to be at least 55 to commence benefits in the construction plan, or at least 60 in the Millman plan to commence benefits. I also want to speak briefly about how we calculate age when we look at pension start dates. For purposes of your pension start date, what we call your pension effective date, we count your age as of the first of the month. So, for example, if you were born on April 23rd and you're going to be 60 years old on April 23rd, we would count you 60 years old as of April 1st. So you could start your pension on April 1st, being considered age 60, even though your birthday isn't until at some point later on during the month. And April's just my example here. Of course, that's true for any given month at all. So we're going to count your age as of the first of the month. So you don't have to pass your 60th birthday and wait until the month after your 60th birthday or 65th birthday for the Millman Fund in order to start a non-reduced pension. So our base monthly pension amount, and that is the A option about halfway down, about in the middle of the page on your personalized estimate. It's called a single life annuity with a 60 certain guarantee, okay? And we're going to look at the calculation of that base pension to start with. So your pension benefit is determined by your pension credits, and those pension credits are going to include those extra halves and quarters for the construction plan that became possible in 1989 and forward. Okay. Also playing a role in your pension monthly benefit amount is the accrual rate in effect at the time your pension starts. So currently on the construction plan, the benefit accrual rate is $100. But I'm pretty sure all of you attending today have heard that as of July 1st, the accrual rate in the construction pension plan is increasing to $125 per year of pension credit. Okay. So that $125 is for the construction fund. For the Millman pension plan, the accrual rate is $66 per year of pension credit. Okay. Now that $125 for the construction and that $66 for the Millman plan are contingent upon you never having incurred what we call a 3-year break in service. Okay. A 3-year calculation break in service means that you have gone 3 consecutive calendar years without earning any pension credit. So if at any point in time during your career as a carpenter, you have gone 3 consecutive calendar years without earning any pension credit, then it is very possible that the $125 and the $66 accrual rates will not apply to you and your pension calculation. And we'll look at an example of a calculation for someone who has incurred a 3-year calculation break in service at some point in their career. Also impacting the calculation is the type of pension for which you are eligible when you retire. So the pension plans provide the following types of pensions. The requirements are slightly different for each. Okay. A regular pension is available in both the construction and the Millman plan. A regular pension is available if you're vested and at least 65. If you are vested and in the construction plan, you are at least 60, but not yet 65, you could be eligible for something called an unreduced early pension. And what that means is that even though you are not 65 years old, you can begin your pension without incurring any type of a reduction for your age. Okay. On the Millman plan, there's no such thing as a non-reduced early pension. On a Millman plan, you either have an early pension or a regular pension. So for the early pension on the construction plan, you have to be at least 55 but younger than 60. On the Millman plan, you have to be at least 60 but younger than 65. If you are not yet 60 in the construction plan or 65 in the Millman plan, there is what's called an early reduction applied for your age. You will incur an early reduction factor on the construction plan of 5% for each year that you are younger than 60. So for example, if you begin your pension when you are 59 years old on the construction plan, you will incur a 5% reduction. You are 1 year younger than 60 if you start at 59. If you start your pension at 55, you are 5 years younger than 60. So it's 5 years times a 5% reduction. You will incur a 25% reduction if you start your pension early on the construction pension side. On the Millman plan, you incur a 6.6 reduction for each year that you are younger than 65, all the way down to age 60. Now, those reductions are actually prorated by month, okay? So if you start your pension on the construction side at age 59 and 11 months, you're only 1 month younger than 60, you're not going to incur a 5% reduction. You're going to incur a reduction of 1/12 of 5%. Okay, so that 5% or the 6.6% for the mill, those are divided by 12 to figure out your monthly reduction. And we do have a calculation example in the slides of what a pension looks like calculated with an early reduction factor applied. Okay. If you're interested in a disability pension, we will be talking about a disability pension later in the webinar. Partial and limited pensions are special circumstances. A partial pension could be available to someone who has a little bit of credit here in the Mid-America Carpenters Pension Fund, but doesn't have enough years here to be vested. Maybe only 2 years here in the Mid-America Fund, but maybe worked 5 or 6 years out in California or Arizona or New York or something. A partial pension is a way we can coordinate benefits with other carpenter pension plans across the country. A limited pension is for individuals who have credit with both our construction plan and with our Millman plan. So a limited pension is a way that we coordinate benefits together between the two pension funds. Okay. So let's talk a little bit about payment options and how the actual calculation works. So on the slide where we looked at your individual estimate with the B on the top right, and you will want to still be looking at that estimate as we go through the next several slides, I mentioned that the base pension is called a single life annuity with a 60-month guarantee. So this type of pension, it is a monthly pension payable for the retiree's lifetime. Okay, that's what a single life annuity is. It's something payable for the retiree's lifetime. There is no maximum number of payments. The monthly pension will continue until the retiree passes away. Okay, so you will get a monthly pension every month from when your pension starts until such time as you, the retiree, the carpenter, pass away. However, built into that single life annuity is a 60-month guarantee. That means that there is a minimum of 60 monthly payments guaranteed in case you, the carpenter, you, the retiree, do not actually live for 60 months after your pension starts. And we'll look at an example of that on the next slide. The important thing to understand here is that the monthly benefit continues for the retiree's lifetime. Even though there's a minimum of 60 payments guaranteed, that is only in case the carpenter passes away before 60 months. There's no maximum number of payments. Okay, so for however long you, the carpenter, are still with us, you will continue to get monthly pension payments for your lifetime. In fact, the longest pensioner, the person who has been on pension for the longest period of time right now, has been on pension and receiving a monthly pension payment for 42 years. The gentleman is 97 years old. He started pension when he was 55 years old. He's gotten 42 years of payments, and his current monthly amount is a whopping $460. So a lifetime benefit. We're certainly not kidding around. I can guarantee you that based on the example I just shared with you. So the calculation of the monthly benefit is reflected on your personalized B estimate. Okay. So we are taking the number of years of pension credit that you've earned, okay, and that includes any extra halves and quarters, the 1.25 or the 1.50. The example here is based on a July 1st effective date because the benefit accrual rate is not going up to $125 until July 1st of this year. So it's the monthly pension credits multiplied by the $125. This particular retiree is already 61 years old. He's worked for 41 calendar years, and he has earned the 49.5 pension credits in those 41 years due to those extra halves and quarters. So because in this example, the carpenter, the retiree, is 60 years old, there is no early reduction factor for the carpenter's age. So it's a straight multiplication, 49.5 years of pension credit multiplied by the $125 benefit accrual rate that will go into effect on July 1st. That gives this particular carpenter a monthly pension benefit of $6,187.50. And that monthly benefit, again, is for the carpenter's lifetime. Now let's talk about that 60-month guarantee. Okay. If in this example, the carpenter only receives 48 monthly payments, and then the carpenter passes away, we have not fulfilled our minimum guarantee of 60 months. So the retiree's designated beneficiary will receive 12 more monthly guaranteed payments at this same monthly amount. Okay, so the retiree's gotten 48. 48 plus 12 is 60. And that's how we're getting these numbers here for 48 and 12. Okay. However, if the retiree passes away after receiving 60 or more monthly payments, no additional monthly pension payments would be due to a designated beneficiary. Now, those of you who are married or those of you spouses who are listening with us today, don't panic just yet. I promise you we'll talk about some options later in the presentation that discuss how the carpenter can leave a surviving spouse a monthly pension benefit in case the carpenter passes away first. Okay, so for right now, I'm just making sure that you understand the single life annuity with the 60 certain guarantee. So this next slide is an example of a calculation for a retiree who is not yet 60. So in this example here, the carpenter is 58 and 2 months. He's worked for 32 calendar years. And due to those extra halves and quarters available from 1989 forward, he's earned 42 years of pension credit within those 32 calendar years. Okay. So we take the 42 years of pension credit, We multiply by the $125 benefit accrual rate, which will be in place as of July 1st. And then because in this example, the carpenter is not yet 60, there is an early reduction factor involved. Okay, so as I mentioned on a prior slide, the reduction is 5% for each year younger than 60, but it's prorated by month. So the early reduction factor here is 90.833%. So because the retiree is 58 and 2 months, he will be receiving 90.833% of the base pension, 60 certain amount, that would have applied when he would be age 60 in the construction plan or age 65 in the Millman plan. Okay, so that leaves a monthly benefit amount of $4,768.73. By the way, monthly benefit amounts get rounded up to the next 50 cents. So when we actually process this particular carpenter's pension, the monthly amount will be $47.69 because it rounds up to the next 50 cents. So our next example is of an individual with what's called a 3-year calculation break-in service. So in this example, this particular carpenter is 58 years old when he's going to start his pension. He worked here in the Mid-America Council from 1988 to 1996 and earned 11 3/4 years of credit during that time frame. And then he stopped working here or stopped earning credit here from 1997 to 1999. So that's a 3 calendar year period, 97, 98, 99. That's a 3-year period without any credit. But then he returned and started working in covered employment again for a signatory employer and worked again from 2002 to 2021 and picked up an additional 21 3/4 pension credits. So it's a 2-part calculation when there is a 3-year or more calculation break-in service. So this credit earned from 1988 to 1996, the 11 3/4, is paid at the $50 benefit accrual rate, which was in place in 1996. And then the credit that was earned from 2002 to 2021, that was an additional 21 3/4. That's paid at the $125 accrual rate that will go into effect in July, assuming, of course, that the carpenter is waiting until July to commence the pension benefit. Now, in this example, this retiree is also 58 years old, so that's 2 years younger than age 60. So the reduction factor is 5% for each year that you're younger than 60. So you're 2 years short of 60, or this example, the carpenter is 2 years short of 60. So 5% times 2 years is a 10% reduction. So this retiree will be receiving 90% of the base pension amount because pension benefits will commence early, prior to age 60. Okay. So you see the 2 separate calculations. We add those 2 amounts together to get a monthly pension benefit amount of $2,975.63. So that will be the carpenter's monthly benefit amount for the carpenter's lifetime. Now, when we look at these examples that have an early reduction factor, a lot of times they'll get a question during a webinar or during the in-person seminars. Well, then what happens when I reach 60? Does that early reduction factor go away? And the answer to that is no, it does not. So if you commence benefits prior to 60 in the construction plan or prior to 65 in the Millman plan, that age reduction that you will incur is a permanent age reduction for your lifetime. It does not go away once you reach age 60 or 65. So it's a permanent reduction. Single life annuity with 60-month guarantee is the base monthly pension amount. But of course, the majority of you registered today are indeed married. So if you are married, the thought of your pension just stopping in case you pass away before your spouse might not be something that you really want to happen. So the plan offers 3 different options. They're called qualified joint and survivor options. And these offer a way for you, the carpenter, to take a little bit less money during your lifetime to provide a monthly pension benefit for your spouse for the spouse's lifetime in case you, the carpenter, pass away first. So the plans offer 3 different options: a 50%, a 75%, and a 100% option. Okay. Under federal regulations, you must elect at least a 50% joint and survivor benefit if you are married at the time your pension starts. If you are married at the time your pension starts and you don't want to elect at least a 50% or a 75 or 100%, then there is a form that your spouse needs to fill out to consent to your taking that single life annuity benefit, which only guarantees a benefit for the carpenter's lifetime. Okay. Our next slides are going to show some calculation examples, and you can see your personalized individual calculations on that B estimate that you currently have. Okay. The participant amount on that estimate is the amount that will be paid out while you, the carpenter, are still living. And then the surviving spouse amount on that estimate is the amount that your surviving spouse will begin to receive upon the carpenter's death. Okay. And it is a lifetime benefit for the surviving spouse. Okay. So if at some point in time your spouse subsequently remarries, the monthly pension benefit does not go away. The surviving spouse can remarry and still receive these benefits. Okay. So sometimes when we have participants come into the office in person and the participant and the spouse will come in together, we're talking about different pension payment options, and we start talking about what happens, when somebody passes away. It's not a particularly pleasant topic, but for purposes of planning, we really do need to discuss these things today. So it's not my intent to make anyone feel uncomfortable or to feel like they're, counting their days. We hope that everyone is here with us for a long, long time to come. But we do need to talk about what happens based on who may pass away first. Okay. So I'm going to move on to the next slide. And again, I encourage you to keep looking at your personalized estimate. And the next slide will show some calculation examples for these. Okay. So in this example, we are going to take our base example through for the joint and survivor examples. So our initial example, the retiree was 60, earned 49.5 years of pension credit, did not have a calculation break in service. For our example, the spouse is also the same age as the carpenter. So the spouse is also 60 years old. So to figure out the amount of a qualified joint and survivor pension, we still have to do the base calculation of the single life annuity with the 60-month guarantee. So we still take the 49.5 years of pension credit and we still multiply by that $125 benefit accrual rate, which will take effect in July. But then what happens is we apply something called a joint and survivor factor. Okay, so we take this $61.8750 monthly amount. I'm just bringing that down here in the green shaded area toward the bottom of the screen. Okay, for a 50% joint and survivor benefit, we take the $61.8750 and we multiply by 90%. So the carpenter will receive $55.6875 each month during the carpenter's lifetime. So instead of the $61.87 a month, the carpenter draws $55.68 for the carpenter's lifetime. And the carpenter will draw that $55.68 every month for the carpenter's lifetime as long as the carpenter lives. When the carpenter passes away, the $55.68 stops. The $55.68 goes away when the carpenter passes away. But because a 50% joint and survivor option was elected, the surviving spouse will start to get 50%, will start to get half of what the carpenter was drawing for the surviving spouse's lifetime. So $27.84 will be paid to the surviving spouse for the surviving spouse's lifetime. So on the 50%, the surviving spouse is receiving half of the carpenter's monthly amount. On a 75% joint and survivor option, we again start with that base $61.87 amount, and we multiply by an 85.5% factor. So the carpenter would draw $52.90 a month for the carpenter's lifetime. Pardon me. The carpenter would draw $52.90 for the carpenter's lifetime. When the carpenter passes away, the $52.90 goes away, but the surviving spouse starts to receive 3/4 of that amount. So the surviving spouse starts to receive $39.67 a month for the surviving spouse's lifetime. On a 100% joint and survivor option, we take that $61.87 that we started with, and we multiply by a joint and survivor factor of 81%. So instead of drawing $61.87 a month, the carpenter will draw $5,011 a month for the carpenter's lifetime. When the carpenter passes away, the $5,011 a month that the carpenter was drawing goes away, but the surviving spouse starts to draw 100% of that amount, starts to draw that same monthly amount for the surviving spouse's lifetime. Okay. It's a surviving spouse's benefit. So the surviving spouse's benefit does not start until after the carpenter passes away. Sometimes people look at their individual estimates and they think that the surviving spouse will draw a benefit at the same time that the carpenter is drawing a benefit. Well, if that were the case, and it's not, but if that were the case, wouldn't that be lovely? The surviving spouse would get a $5,000 check and the carpenter would get a $5,000 check. It doesn't really even make mathematical sense if you think about it, because that's $10,000 a month, which is certainly significantly more than the base monthly amount of $6,187. Okay. So the surviving spouse starts to draw the month after the carpenter passes away. And it does not matter how old the surviving spouse is. Okay. So the surviving spouse would not have to wait until the surviving spouse is 60 or 65 or anything like that. The surviving spouse's benefit starts the month after the carpenter passes away. Okay. Now, in my example here, this 90% factor, the 85.5 factor, and the 81 factor, you may notice on your own personalized benefit estimates that you have that your numbers are different from these. Okay. These are the factors that apply when the carpenter, who in our example is 60, is the same age as the spouse. So the spouse is also 60 for these particular factors. On your personal estimates, you will see the factors that apply to you and your spouse if you are not the same age. On the 50% benefit, we always start with the base of 90, and then we add or subtract 0.4%, depending on how many years older or younger the spouse is than the carpenter. On the 75% option, we start with the base of 85.5, and we add or subtract 0.6%, depending on the difference in the carpenter's age and the spouse's age. And on the 100%, we start with the base of 81%, and then we add or subtract 0.7%, based on the difference between the spouse's age and the carpenter's age. So you don't have to do the math on those. They're on your individual printouts. I just wanted you to have the factors available for you to know that, there is a formula for this. It's not just numbers that we're kind of pulling out of a hat somewhere. Okay. So as I was talking, a question came through about a cost of living increase at any time. Are these numbers locked in, or will there be a cost of living increase? There are no guaranteed cost of living increases built into the plan. Okay, so the answer to the question that was asked, if there is a cost of living increase built in, the answer is no. However, historically, the trustees have granted several increases over the course of the plan. The most recent increase was actually back in September of 2019. And for that increase, how much of an increase the retiree received was based on how long the retiree had already been retired. And it was purposely set up to give the retirees who have been on pension for a longer period of time a greater percentage increase. Someone who retired, 30 years ago, maybe when the accrual rate was only $50 or even $40, or someone who's retired even earlier than that. And there was a point in time in the construction plan that the accrual rate that we multiplied by was only $11.20. So for the September 2019 increase, for the individuals who retired prior to 1999, it was a 10% increase. Between 1999 and 2004, it was a 6% increase. Between 2005 2009, it was a 4% increase. Between 2010 and 2014, it was a 3% increase. And then 2015, through the date of the increase, it was a 2% increase. Prior to that particular increase, the last monthly permanent increase was all the way back in 2007. In addition to particularly looking at increases that would permanently affect your monthly amount, there have been at times annual bonus payments or bonus payments made at times determined by the Board of Trustees. So this year, in March of 2022, there was a bonus payment issued, a one-time bonus payment issued. This particular time, it was a formula bonus, again, set up to give those who have been retired the longest the largest bonus amount. So this year, the retirees' bonus was calculated. There was $75 multiplied by how many years someone had already been retired, and $21 multiplied by how many years of pension credit were earned and used in the pension calculation. So there have been bonus payments over the years. Again, bonus payments are not guaranteed. Sometimes they're a formula payment, and sometimes they're what some folks like to call a 13th check, where your bonus payment is just equal to one monthly pension check. A schedule of those past bonus increases, I believe, is available on our website or is available in the summary plan description. Or if you're interested, give the fund office a call and we can certainly go over those on a one-on-one basis. The question came through about what determines the base percentage factor on these joint and survivor factors. And the answer is our fund actuaries. So we have fund actuaries, the number crunchers, the accountants, and it's based on, for the joint and survivor factors, it is mostly based on life expectancy. Okay, we'll talk a little bit about actuarial factors also when we talk about the partial lump sum payment option. So all of the joint and survivor options have built into them what is called a pop-up feature. Okay, so what happens if you've taken a joint and survivor, and here, for example, I've only put the 50%, but what I'm going to talk about applies to the 50 and the 75 and the 100% options. It applies to all of the joint and survivor options. So on the prior screen, I talked about what happens if the carpenter passes away first. Well, what if you've taken one of these joint and survivor benefits and if the spouse passes away first? Okay, So the benefit will automatically convert from a joint and survivor benefit back up to the full single life annuity with 60-month certain guarantee amount, effective the month after the spouse passes away. Okay. Now, when I say automatically, well, once you notify the retirement benefits department that your spouse has passed away, we will make this calculation. So there's no forms you need to fill out or anything. You will need to send us a copy of your spouse's death certificate in order for this change to happen. Okay, but we will automatically recalculate the benefit back to the full 60 certain guarantee. So for example, if you had, in our example on the last slide, if you had selected the 50% joint and survivor option, and if the carpenter was receiving 5568, thinking that if the carpenter passed, the spouse would have started to get 2784, but if the spouse passes first, of course, this 2784 is no longer needed. So the carpenter's 5568 increases up to the 6187, and that increase will be effective the month after the spouse dies. Now, depending on how quickly you notify us that your spouse has passed and on the timing in the month, like when we're cutting the pension checks, this 6187 increase might not be on your next pension check. It might take 2 months or maybe even 3 months for you to see this increase, but we will give you also the back money for any months that pass between the time of the calculation and the time your spouse passed away. So for example, if your spouse passes away in April and you don't notify us until the middle of May, of course, we have already issued your May payment at your regular monthly amount. So we could process that increase up to the 6187 for June, and then you would also get the difference between these two amounts for the month of May added onto your June payment. Okay, so this increase begins the month after your spouse dies. Okay, it is important to understand that there are no retroactive payments of the amounts held back for the spouse's benefit all the way back to your pension start date. That does not happen. This change does not go back to your pension start date. Okay, the change starts the month after your spouse dies. Some people will say, oh, well, that's not fair. Well, kind of think of it like insurance. You know, if you take insurance on your home, for example, and you have fire insurance on your home, you've paid a monthly premium, and if you've paid that monthly premium for 5, 6, 10, 20 years, and if you never have a fire, well, you can cancel your homeowner's insurance, you can cancel your fire insurance, and that premium, that monthly payment, will go back into your pocket as of the month after your cancellation, but you don't get any back money on those insurance premiums that you paid for all those years. So it's not an exact example, but just kind of something, a context for you to think about it within. So this increase back to the 60-month guarantee, the single life annuity with the 60-month guarantee, of course, that benefit would stay in place for the rest of the carpenter's lifetime. Okay. Now, this particular slide only applies to the construction pension plan, okay? Not to the Millman pension plan, but in the construction pension plan, if the retiree passes away after receiving 20 monthly payments and the surviving spouse's pension begins at the surviving spouse's amount, and then the surviving spouse receives, for example here, an additional 12 monthly payments. Okay, so the carpenter has gotten 20 and then passed away. The spouse starts getting benefits and gets an additional 12. So in total, we've paid 32 monthly payments. The retiree's designated contingent beneficiary will receive the last 28 payments at the surviving spouse's monthly amount. Okay, because we guarantee at least 60 months minimum, Only 32 have been paid to the carpenter and surviving spouse. So there are 28 more payments due to bring it up to the 60-month guarantee. Okay. When you fill out your pension forms, we will require that you complete new beneficiary designation forms, and a little later in the presentation we'll look at beneficiary designation forms. But you will want to make sure that you designate, if you're taking a joint and survivor benefit, you're going to designate your spouse as your primary beneficiary, and then you're also going to designate contingent beneficiaries who may be entitled to some monthly payments if both the carpenter and spouse pass before we've actually paid out all 60 payments. So, still looking at your individual B estimates, okay, and keeping in mind all of the information that we've gone over. In the handouts, I've snipped a page from page P25 of the pension handouts. I've snipped this section here. At the time you actually apply and fill out your pension application, you make a choice between the payment options that we've talked about. You either elect the single life annuity with a 60-month guarantee, or you pick a 50% joint and survivor, a 75% joint and survivor, or a 100% joint and survivor. For those of you listening today who have both construction and Millman credit, who might be looking at a limited pension, this 100% option is not available to a limited pension. Okay, so on your pension application is when you're going to make the choice for which of these payment options you want to elect for your monthly pension. Okay. Several slides going forward, we'll talk about what happens if the carpenter passes away before his pension begins. Okay. So in your personalized estimates, there is also an estimate for a partial lump sum payment. So that's got a C like in cat, on the top right-hand corner of your personalized estimate. So if you do have those personalized estimates, I would suggest that you put them side by side. You put the B estimate that we've been looking at and the C estimate here, you put them side by side so that you can see them at the same time. So starting in 1995, it became possible for a retiring carpenter to take a part of the pension as a lump sum up front. So you can opt for a maximum of 10% of the total value of your pension as a lump sum up front. The minimum amount available for a lump sum is $1,000. The maximum is 10% of the total value of your pension. There is an actuarial factor that is used to calculate the partial lump sum payment. That actuarial factor changes every July. The whole set of tables that we have change every July. And the individual factor actually changes month to month because it changes for each month, older or younger, that you get. Okay, and I will show you how that factors into the calculation on our next slide. Okay, so I'm still starting with the same base pension example we've been using throughout the presentation. The retiree who is retiring at 60 years old and has 49.5 years of pension credit never had a 3-year calculation break in service. So that base monthly amount that should look a little familiar to you by now from my example, that base single life annuity with 60-month guarantee amount is $61.87. We multiply that by the 10%, which is the maximum percentage allowed on the partial lump sum payment, and that gives us $618.75. The actuarial factor for someone who is 60 years old, exactly 60 years in 0 months, is 209.0647. So we multiply 10% of the monthly amount by the actuarial factor, and we get a partial lump sum payment of $129,358.78. Okay. So if you choose to take advantage of the partial lump sum option, you could get, in this example here, $129,358 paid upfront the first month in which your pension begins. Okay, your individual calculation for that partial lump sum payment is shown on your C estimate in the personalized printouts that you received. Okay. Now, this lump sum, it's not a one and done type thing. It's not that you only get this $129,000 in my example here, or whatever your personal number might be. That partial lump payment is only part of your monthly pension. You still receive a monthly pension benefit for your lifetime. It's just a lesser monthly pension benefit because you're taking a chunk of your benefit up front. So to calculate the reduced pension amount, we start with that base $61.87. We subtract off the amount that we've converted to a partial lump. So we subtract the $618.75 in the example here. And that brings to an adjusted, reduced monthly pension of $5,568. Okay. The lump is also available with the joint and survivor options, all three of them. Okay. It's just the calculation is a little bit different because we start with a lesser base monthly amount. So when we calculate the joint and survivor options, instead of starting here in this column in the green shading at the bottom where the red numbers are, in the prior example where we looked at the joint and survivors, we started with the base of $61.87. Well, because we're converting the $618.75 to a lump, when we do the joint and survivor calculations for someone who is electing a lump sum option, we start with the reduced adjusted monthly pension amount. So we bring this $55.68 down. We do the multiplication for the joint and survivor factors, and you can see what the carpenter's monthly amount would be and what the surviving spouse's monthly amount would be for all three of the joint and survivor options. So the amount listed here, the amount listed on your personalized printouts, is 10%, the maximum lump sum amount that is available. If you're looking at these and you're thinking, well, I might be interested in a lump sum payment amount, but I don't want to take my full lump sum. I don't need $129,000 up front. Maybe I've got $20,000 left on my mortgage and, $5,000 left on my car, and I owe Visa $1,000, and I just want to add up those bills and pay off my bills and start retirement with a clean slate. My dad used to say, I don't owe anybody nothing. So he wanted always to start his pension, debt free. So if that's something you might be interested in, or, for whatever reason, you have a dream trip that you and your spouse want to take, and you're going to need $20,000 or $30,000 for that trip around the world. A lesser lump is possible, and you can see your personalized estimates for a lesser lump sum in two different ways. Number one, you can call the Retirement Benefits Department at the fund office, tell them the amount of the lump sum that you're thinking of, $20,000, $30,000, $70,000, whatever the monthly amount, whatever the lump amount might be. And the service representative at the fund office can generate an estimate for you, and can even email that to you, usually the same day, or we can certainly put it out paper mail if you prefer something to come out to you through the post office. The quicker, faster, easier way, which would even allow you to play with multiple scenarios, is for you to register for our new participant portal. You can generate these individual estimates on the participant portal yourself. You can check out what the estimate would be for a lump of $20,000, or for a lump of $21,000, or for a lump of $70,000. You can do all of those calculations on the portal, and have instant results right in front of you where you can see these different options available to you. The pension is federally taxable. As far as whether or not the state taxes your pension, it depends on the individual state in which you will reside as you are drawing your pension when you are retired. Currently, Illinois does not tax pension monies, okay? But the pension is definitely federally taxable. As part of your pension paperwork that you will complete when you apply for benefits, you will fill out a federal tax withholding form, and you will let us know whether or not you want us to withhold federal taxes from your monthly pension benefit amounts. So if you are residing in a state that taxes your pension, you will have to pay your taxes directly out of your pocket to your state. We do not do state withholding. We only do federal withholding. In order to find out which states do tax pensions, you want to speak with your individual tax advisor. The staff at the Pension Fund office are not tax advisors. We don't have that information, and we are not allowed to give any type of tax advice. This partial lump option is only an option. If you are not interested in the partial lump sum option, you certainly do not have to take the partial lump option. You can say no to the partial lump and just go on your way with your base monthly pension calculations and options that we're showing to you on your personalized B estimate. Okay. But if indeed you do want to take the lump option, the partial lump option, you will need to decide what to do with that payment. And I don't mean what you're going to spend it on. Are you going to take a trip to Vegas or a trip around the world, or are you going to buy a new boat? Although all those things might be nice, that's not what I'm talking about right here. You're going to have to decide how we pay that partial lump sum option. And you have a couple of different choices. Okay. Your first choice is on this slide here. We can pay that partial lump sum option directly to you, the carpenter. You will get that partial lump sum check at the same time you get your first monthly pension check. Okay. We are required, the pension fund is required to withhold 20% of that partial lump sum option and send it to the IRS for federal income tax. Just like the withholding on your paycheck, we take money out of the lump check and we send it on to the IRS. Please, please, please pay attention to this next statement. I am not telling you that the lump is taxed at 20%. The lump is taxed at whatever your individual income tax bracket happens to be. Okay, so you should speak to your tax advisor about that. So we hold 20%. If your individual tax bracket is less than 20%, then you're going to get a refund from the IRS when you file the next year's taxes. If your individual tax bracket is actually more than 20%, then you might owe the IRS some more money on this partial lump sum payment. Okay. And actually, I should say we're required to hold at least 20%. If you think that your tax bracket, or if your tax advisor thinks that your tax bracket will be more than 20%, we can certainly withhold a greater amount on this if you would like to. Okay, so you can tell us, oh, I want you to hold 25%, or I want you to hold 28%, or whatever it may be. Here on the partial lump sum option, this is your first option, payment made directly to you. And I would urge you really to talk to a tax advisor about this if you're interested in the partial lump option, especially if you're thinking of having that lump option paid to you, and sort of extra, especially if you're going to go on pension maybe toward the end of the year where you've had an entire year of active working income that's going to factor into your tax bracket. So the entire year of working income, of your paycheck income, you will add to that the amount of this partial lump sum payment, the gross amount of this partial lump sum payment. And then perhaps if your spouse works outside the home and your spouse also has working income, when you add all of those things together, it could have the impact of pushing you into a greater tax bracket if you have this partial lump sum option paid directly to you. Those are just things to think about. I am not a tax advisor, and I urge you to speak directly with your tax advisor about your options. But your next option with respect to payment of the partial lump sum is to do a direct rollover. Okay? We can do a direct rollover directly to a traditional IRA, your own personal traditional IRA, at any financial institution of your choosing. Okay. You can also roll this partial lump sum payment directly into your Mid-America Carpenters Supplemental Retirement Plan, the account that you have at John Hancock. Okay. That is certainly not mandatory. You are welcome to go with an individual IRA of your choosing at the financial institution of your choosing if you're interested in a direct rollover. If you elect a direct rollover, that partial lump sum option will not be taxed in the current year, but it will be taxed as you start to withdraw it from your traditional IRA or from the John Hancock Supplemental Retirement Plan. Okay. So as far as rollovers go, you can do a rollover directly to a traditional IRA or to your Hancock plan. That defers your taxes until you start to make withdrawals from that IRA or from the John Hancock plan. Okay. Your next option as far as a rollover would be to do a rollover to a Roth IRA. Okay. So if you're a little bit familiar with Roth IRAs, you would know that they are post-tax vehicles. So the rollover goes into the Roth IRA. It is still taxed in the current year that we make payments, and we are still required to hold 20% to send to the IRS for this taxable income. However, as you start to withdraw it from the Roth IRA, that income is not taxed as you make withdrawals. Okay, so if you're interested in a Roth IRA, you want to look at IRS Publication 590. You can just go to irs.gov and you can bring up Forms and Publications and you can search for Publication 590, and that would give you information on a Roth IRA, or again, you can speak with your tax advisor. As I mentioned before, you do not have to take advantage of the partial lump. It is an option. So at the time you fill out your pension paperwork, you will receive a partial lump sum election form. So in Part A of the form, and this is also in the handouts, in Part A of the form, the top box is, no, I don't want to elect a partial lump sum at all. I'm just not interested. The middle box is, yes, I want that full 10% partial lump sum. And then the bottom box is, yes, I want a lump sum, but I want to elect a lesser partial lump sum. I don't want the full 10%. And then you will fill in the amount that you are going to elect here on this line. If you're not taking the partial lump, you check that top box, you sign this part of the form, and you're done. If you are taking the partial lump, in Part B, you have to let us know how we're going to pay that lump. Are we going to pay that lump directly to you where you do not want to roll it over? That's the top box. The bottom box in Part B is that you want to do a rollover. You check that. If you are going to do a rollover, on the back of this form, there is a Part C where you have to give us your financial institution information so that we know where to send that partial lump sum payment check. If indeed you want to roll over the check into your John Hancock supplemental plan, there's one more additional form that needs to be completed, and we can certainly help you obtain that from John Hancock, and we can help you with the John Hancock mailing address here. Okay. So this is what the form looks like. I will also say that under federal regulations, If you are married and if you are going to elect the partial lump sum payment option, there is an additional form where your spouse needs to consent to your taking the partial lump sum payment option. It is a federally required form because your taking the partial lump sum option will decrease the amount of the monthly pension payment your surviving spouse could be entitled to in case you pass away first. And the federal government says that the surviving spouse gets, that a spouse, kind of gets a say in the election of the partial lump sum option in the same manner that the spouse, kind of gets a say in whether or not you can take a single life annuity with a 60-month guarantee. So those are federally required forms that the Retirement Benefits Department must comply with. Okay. You have a third payment option. This level income option only applies to the construction pension fund. It does not apply to the Millman pension fund. And you also have to meet a few other requirements in order to qualify for this level income option. Okay? You have to be at least 60 years old, and you have to have at least a quarter year of pension credit within the 3-year period before starting your pension. You cannot combine this level income option with the partial lump sum option that we just spoke of. It's one or the other. So if you're interested and want to take the partial lump sum option, you would not be eligible for the level income option, and vice versa. Okay. This level income option can be of assistance if you are starting pension prior to reaching Social Security age, prior to reaching age 62. So you're starting your pension early, you have your pension as your source of income, but of course you're not eligible for Social Security until at least age 62. So in order for us to furnish you with an estimate for the level income option, you need to send the Retirement Benefits Department your personalized Social Security estimate. You can get that by creating your own individual Social Security account on the Social Security website at ssa.gov. It's free, it's easy, it takes about 5 minutes to set up an account, and then you can log into Social Security and you can actually get estimates of benefits for how much Social Security you would draw at different ages. Okay. Once you are receiving Social Security benefits, you can use the Social Security portal to set up or change your direct deposit, to get paperless statements, change your address to Social Security, and request benefit verification letters. But for our purposes here, you would need to create an SSA.gov account or contact Social Security via phone to obtain your Social Security estimate. Once you have your Social Security estimate, you would send that Social Security estimate into the Retirement Benefits Department, and then we could then furnish you with a level income estimate. So in our example here, this particular carpenter has 42 years of pension credit and is 60 years old. Okay. Retiring July 1st of 2022, when the benefit accrual rate will go up to $125. So we still calculate the base single life annuity with the 60 certain. So 42 years times $125 gives a monthly pension benefit amount of $5,250. For the level income option, the same retiree plans on receiving Social Security benefits at age 62, and the estimated Social Security benefit that is furnished to the Retirement Benefits Department shows a monthly Social Security benefit of $1,200 a month. So the Pension Fund Office does that bottom calculation. We take the $1,200 Social Security benefit. We have another set of Actuarial Factor tables that we use. And those tables say that for someone who's retiring at age 60 and who's going to start Social Security at age 62, the level income factor is 85.8%. So we do the multiplication and we come up with a Social Security level income amount of $1,029.60. Okay. The next slide is the next part of the calculation. We take the base monthly 60 certain of $5,250 that we've calculated. We add to that the level income amount of $1,029. And this particular carpenter will receive a benefit from the pension fund of $6,279 a month every month from the time the pension first starts up until the time that Social Security begins at age 62. Okay. 2 months after the retiree reaches age 62 and begins receiving Social Security, the pension benefit payable from the pension fund is adjusted as follows. So we take this $62.79 that the pension fund has been paying out monthly. We subtract off the full amount of the $1,200 that the carpenter will be getting from Social Security, and the new benefit payable from the pension fund after Social Security begins is $5,079.60. This is called a level income option because the carpenter's income remains level both before and Social Security. Before Social Security kicks in, the pension fund is paying $62.79 a month. Once Social Security kicks in, the carpenter is still receiving $62.79 a month. It's just $1,200 of it is coming from the Social Security Administration, and $5,079 is coming from the pension fund office. This option has been available since 1996. It is not a terribly popular option, but it is out there, and it's something to think about if perhaps you are electing to go on pension prior to age 62 and you need maybe a little bit of additional money in your pocket to help you out with expenses until your Social Security benefit begins once you are age 62. Okay. We're going to briefly look at a disability pension. In order to qualify for a disability pension, you need to be completely disabled for any type of gainful employment, okay? Not only to work as a carpenter or in the building trades, but you must be unable to do any substantial activity. That's work that utilizes any mental or physical duties or a combination of both. And gainful activity is work that is performed for profit. You get paid for that work. So you have to be completely disabled for any type of substantial gainful activity. Okay, so that's the disability standard you need to fulfill, and we'll talk about proof requirements in a moment. In addition to being disabled for any type of gainful employment, you also need to meet some credit requirements. In the construction plan, you need at least 15 years of pension credit, or if you don't have 15 years of pension credit, you need at least 10 years of pension credit, but then going along with the 10 years is a requirement that you have at least a quarter year of credit in the year you became disabled or any of the immediately preceding 5 years. On the Millman plan side, you need at least 10 years of pension credit, but you have to have earned a quarter of a year of credit in the year that you became disabled or one of the immediately preceding 2 years. In order to provide the fund office with proof of your disabled status, you either must furnish us with a Social Security Disability Award letter under the Title II Social Security Act, so that's Social Security Disability, or if you do not yet have Social Security disability, you can certainly still file a disability pension application before you get Social Security disability. But if you don't yet have the Social Security Disability Award, you need to submit medical records to the Retirement Benefits Department, and those medical records must substantiate your claim of total disability. The fund office staff, the retirement benefits department staff, we are certainly not doctors or medical consultants. So what we do is we take those medical records and we send them to an outside independent medical consultant. And that independent medical consultant evaluates the records that you've submitted to determine whether or not you meet the plan's definition of being disabled for any type of gainful employment. Remember, not just carpentry, but for any type of gainful employment. With respect to the payment options on a disability pension, and the disability payment options fall into the categories that we've already discussed. So on a disability pension, no matter how old you are, there is not an early reduction factor. So on the construction side, we calculate it as if you're 60. On the Millman side, we calculate it as if you're 65. So you don't incur any type of reduction for being disabled prior to those ages. A disability pension can be paid as a single life annuity with a 60-month guarantee, but you also have the 50, 75, and 100% joint and survivor options available to you. The partial lump sum option is also available. The level income option is not available on a disability pension. So that's the level income option not being available, and there not being an early reduction factor included in the calculation are the two main differences between a disability pension and a non-disability pension. A little bit later in the presentation, we're going to talk about work restrictions to be on pension. The work restrictions differ a little for disability pension. So for disability pension, remember, you're not supposed to be able to do any substantial gainful activity of any kind. So for a disability pension, you can do a little bit of work that is considered not to be substantial. So you can do a little bit of work in non-carpentry, non-building type employment without losing your disability pension, as long as you don't go over what Social Security sets as a substantial gainful activity earnings limit. Okay, that limit's adjusted every year. For this year, the earnings limit is $1,350 a month. So you would be able to earn $1,350 a month from work, non-substantial work, while still keeping your disability pension. So, for example, I personally, back in the days when I was a service representative, I put a gentleman on pension, a disability pension, and a couple of mornings a week, he literally baked the biscuits at McDonald's. He wanted to get out of the house. He didn't want to just sit around, but of course he was disabled. He wasn't able to do any substantial work. So a couple of mornings every week, he literally went to McDonald's and, baked biscuits for a couple of hours on the breakfast shift. So when we're talking about a disability pension being able to work, we're certainly not talking about being able to work at any type of substantial employment. Part of the handout packet contains disability forms. If you are applying for a disability pension, there's a couple extra pages to the application. One of them is a form for you to fill out regarding your medical condition. One is a form for your doctor to fill out regarding your medical condition, and then another is a consent form. If you don't yet have Social Security disability, you'd have to sign a consent form so that we can send your medical records to our outside independent medical consultants. You and your spouse have been married for at least 1 year at the time of the carpenter's passing. Under the construction pension plan, the surviving spouse would start to receive a 100% joint and survivor benefit. And under the Millman plan, the surviving spouse will start to receive a 50% joint and survivor benefit. Okay. That benefit will start the month after the carpenter's passing. It does not matter how old the spouse is or how young the spouse is. It will be calculated as if the carpenter commenced pension benefits the month before the carpenter passed away. You, the carpenter, are not yet 60 in the construction plan or not yet 65 in the Millman plan, an age reduction factor will be part of the calculation. So that 5% on the construction plan or 6.6 annual early reduction factor, those numbers will come into play if you are not 60 on the construction side or 65 on the mill side. If you pass prior to 55 on the construction side or prior to 60 on the mill side, when we do the calculation, we basically pretend like you were 55 or 60, and that age 55 or age 60 early reduction factor would be applied to the calculation. Okay. So most of you registered today are married, so you would be looking at the 100% on the construction or the 50% on the Millman as a pre-retirement benefit for your spouse. Again, just like we spoke about in the earlier examples, the spouse's benefit starts the month after the carpenter passes away, and that benefit is a lifetime benefit for the surviving spouse, regardless of whether or not the surviving spouse subsequently remarries. So it is a lifetime monthly pension benefit. Okay. If you were not married at least 1 year at the time of your passing, but you are early retirement age, then we would calculate your benefit as if you went on pension the first of the month in which you passed, and your designated beneficiary would receive a pre-retirement 60-month guarantee. So your designated beneficiary would get 60 monthly pension payments. And by the way, if I didn't mention this earlier, 60 months is equivalent to 5 years. Okay, so it's the same thing. 60 months is 5 years. So if you're early retirement age but not married at least 1 year, there's a pre-retirement 60 certain guarantee. If you are not yet early retirement age, there are credit requirements that you need to meet, and you can read those on your screen. But if you're not yet early retirement age, provided you meet the credit requirements, something called a pre-retirement death benefit pension is payable. On the construction plan, we take your total years of pension credit and we multiply it by $875. And that gives us the grand total amount of death benefit payable. And then that amount is divided by 60 because that amount will be paid out in 60 equal monthly installments, monthly pension payment installments to your designated beneficiary. On the Millman side, we take your total years of pension credit and we multiply by the mill death benefit rate, which is $345 to get the total benefit payable. Same concept, that total benefit payable is divided by 60 and it is paid out in 60 equal monthly installment payments to your designated beneficiary. Once you are retired and receiving a monthly pension benefit, there is a post-retirement one-time lump sum death benefit paid to the retiree's beneficiary. Okay. On the construction pension plan, there is a one-time $3,000 lump sum death benefit payable. On the Millman pension plan, there is a one-time $2,000 lump sum death benefit payable. Now, these amounts are only payable when the participant passes away. They're not payable if a surviving spouse passes away. Okay, and you have to be in pay status. You have to be receiving a monthly pension payment at the time of your passing. For retirees who receive a pension benefit from both the construction plan and the Millman plan, you don't get $5,000. It's not $3,000 plus $2,000, but you do get the $3,000. You get the greater of the two amounts if you are receiving a pension benefit from both the construction plan and the Millman plan. Your total benefit is $3,000. When you fill out your pension papers, you will receive forms to designate a beneficiary for this one-time lump sum death benefit. Part of your benefit package under the active working health benefit plan is that you have a $50,000 life insurance policy through the Hartford. It used to be Aetna. Hartford took over Aetna, I want to say about 2 years ago, maybe 3 years ago. So part of your active medical benefit package is a $50,000 Hartford life insurance policy. Okay. That benefit is going to end when your active health benefits end. There is a Hartford benefit available for the retirees, and we'll talk about that when we get to the retiree health benefits. But I did want to make sure to mention that that $50,000 Hartford benefit ends when your active benefits end. You can convert that to an individual self-pay basis directly with the Hartford, and you don't have to convert the whole $50,000. You can convert it in $1,000 increments. So you could do a $1,000 policy, you could do a $10,000 policy, you could do a $20,000 policy. If you are interested in the premiums for that, please contact the health benefits department at the fund office. So when you call in, that's phone option number 3. You'd call to the health benefits department and let them know that you have questions about how much it costs to convert that $50,000 Hartford policy to an individual self-pay policy once your active working carpenter health benefits end. If someone is age 55 and wants to stop working as a carpenter, does he have to start his pension right away? And the answer is no, he does not have to start his pension right away. But if he waits for more than 3 calendar years to start his pension, then he will have a 3-year calculation break, and his accrual rate for calculating the monthly benefit will be locked in at the accrual rate for when he stopped earning credit. And this printout shows you the dates of your most recent beneficiary forms, the dates that they were filed with the pension fund office. And it also shows you, if indeed you have a John Hancock balance, it shows you your John Hancock approximate balance as of the beginning of April, as of the beginning of this month. Now, if any of you follow the market, even with half an eye, you know that the Dow Jones average has been going down steadily. So your current John Hancock amount, there's a good chance that it's less than the amount quoted here on this form. But in our John Hancock slides, we'll talk about the John Hancock portal and how you can log in there to see your individual John Hancock balance. Okay. If you see the word none on this printout, it means that you do not have a beneficiary on file for that particular benefit fund. So if you know that your pension is through the construction pension fund and it shows Millman Pension Fund, no beneficiary, I certainly would not be concerned about that, or vice versa. Okay, but you really should have a beneficiary on file for either the construction or the mill, or if you have credit with both funds, and you should have a beneficiary on file for the supplemental retirement plan also. Okay. Designating beneficiaries is one of the most important things that you can do. Okay, and the handouts contain beneficiary forms for both the pension plan, the supplemental retirement plan, and if you are still eligible or right now eligible for the active health benefits, there's also a beneficiary form there for the $50,000 Hartford life insurance beneficiary. Okay. To designate a beneficiary, you want to complete a beneficiary form. They're in the handouts, or they're available on our website at carpenterbenefits.org, or you could certainly call the Retirement Benefits Department if you would like a blank paper beneficiary form mailed out to you through the post office for completion. Your beneficiary designation needs to be on file with the fund office prior to your death. You may choose beneficiaries, and you can name contingent beneficiaries in case your primary beneficiary passes away before you. Okay. You can change your beneficiary designations at any time in the future. However, if you are married, your spouse must be your witness on your beneficiary form and consent to those changes. If you do not have a beneficiary form on file, if you see none in, one of those categories, if you are married under the plan rules, if you're married and you do not have a beneficiary form on file, your spouse is automatically your beneficiary. Okay? So there is an order of succession in place. Okay? If indeed you are married but you don't want your spouse to be your beneficiary for some reason, you want someone else to be your beneficiary, you have to be at least early retirement age to name someone other than your spouse as your primary beneficiary, and your spouse would have to consent to naming someone else as your beneficiary. So if you have the forms available, or if you have the handouts available, you'll see that each of those forms is two-sided. The front of the form is your primary beneficiary, and there are 3 beneficiary spaces on the front of the form for a primary beneficiary. If you are married and you want your spouse to be your primary beneficiary, you only fill in the first one of those beneficiary sections. You leave the other 2 primary beneficiary sections blank. On the back of the form is more often where we talk about contingent beneficiaries, children, friends. A lot of people want their children to be their secondary beneficiaries. Secondary or contingent is another way of saying secondary beneficiary. Okay, in case the carpenter and the spouse both pass away. Okay, and sometimes on the forms we see on the contingent section, people have 3 or 4 kids, or 2, 3, 4 kids, and they only name one of the children as the secondary, as the contingent beneficiary. Okay, you're certainly welcome to do this. You might think, Johnny's a good boy. Johnny's going to split his benefits with his siblings, and I know that Johnny is going to take the benefit that gets paid to him, and he's going to split it with Susie and Davy because Johnny's a good boy. Well, a couple of things to think about with that. Usually when we do these seminars on an in-person basis, I kind of hear a little bit of snickering around the room. There's a couple things to think about. Even if Johnny is a good boy and he does split that benefit with Susie and Davy, from the IRS's standpoint, we're paying the money all to Johnny, and it's all going to be taxable income for Johnny. Okay, so if you want to split the benefit over more than one child, or even over more than one friend, it doesn't necessarily have to be your children. If you want more than one person to be a beneficiary, make sure you name each of those people individually so that everyone pays the IRS their own taxes on their own benefit. Okay? And the other point that I usually like to make is you just never know what's going to happen in the future. If you have an unclear beneficiary designation, maybe Johnny will think that you wanted him to have the whole benefits. My dad passed away a few years ago. I have 2 brothers. And there was a little bit of tension over who got what. We, of course, worked it out. We're one big happy family still, but just make sure that your wishes are followed by designating each individual beneficiary. If you die without a designated beneficiary on file, I've already mentioned that your surviving spouse is your primary beneficiary. If you do not have a surviving spouse, then the next in order of succession, if you do not have a beneficiary form on file, would be any surviving biological or legally adopted children that you may have. If you don't have any kids, it would be your parents in equal shares. And if your parents are no longer with us, then the Retirement Benefits Department is actually going to look at whoever you named as a beneficiary on your health fund life insurance beneficiary form, sometimes also called an enrollment form. So, if you joined the union 20 years ago, at that time you filled out what's called an enrollment form, and that contained the name of your life insurance beneficiary. So we'll look back to that enrollment form. still staying with beneficiaries, I would like to mention on the supplemental retirement plan, actually the fourth bullet point here is different. The supplemental retirement plan, your John Hancock balance, if you don't have a beneficiary on file and if there is no spouse, children, or surviving parents, then that benefit goes directly to your estate, not to your health fund life insurance form. Applying for benefits. So a big question is always, when should I apply? How far in advance do I have to apply? Again, I'm going to mention we're open. The fund office is open. You can come into the Chicago office or the Lisle office in order to apply. The Chicago office takes appointments Monday through Friday for pension applications. The Lisle office takes appointments on Tuesdays and Thursdays for pension applications. You also do not have to come in person. You can mail in or even email in your application, okay? A lot changed as a result of the pandemic. We never used to take an emailed application. I suppose you could even fax if you still have a fax machine. You can fax in your application. So how far in advance? We recommend that you call the Retirement Benefits Department 5 months ahead of time for an application packet. We recommend that you submit your completed application approximately 4 months in advance of the date you want your pension to start. And please keep in mind that pension application packets are only valid for 6 months from the date they are sent out to you. Okay? That's in accordance with federal regulations because the packet contains information that the federal government says we have to furnish to you. Information about the partial lump, about your options with respect to rolling over the benefit, written information about how all of the joint and survivor benefits work and how the pop-up works, and written information about the relative value of all of your different payment options. So an application is only valid for 6 months from the date it is sent out to you. July is going to be a really busy month. That accrual rate jumping from $100 to $125 has made July probably turn into the biggest pension start month in the history of the plan. If you don't get that application into the fund office within the next week or two, you may still be entitled to a July pension payment, but we're not going to be able to process you for a check the first week of July. Your effective date is the date that you are first entitled to pension benefits. So to be entitled to July pension money, the absolute deadline for your filing your application is the end of June. Okay, so let me say that again. In order to be entitled to July pension money, your absolute filing deadline is the end of June. But I guarantee you that you're not going to get your first pension check the 1st of July if indeed you wait until the end of June to file. So in addition to an effective date, we also have something called an award date. The date the fund office issues your first check is an award date. Okay. If your award date is later than your effective date, your first check is going to include any retroactive payments that may be due to you. So for example, you apply for pension at the end of June. Say you come in on June 20th and you turn in your pension application, you have everything completed and you're entitled to July pension money because you file in June. But we're already done processing July. We are going to be done processing July by the first, whatever the first Friday in June is the date that our outside auditing firm comes in to look at the July pension applications. So if you apply at the end of June, you'll probably get a check in August or September. That first check will go retroactive and it will have the July and August and September payments on it. But in order to cut a check on the date that you want to start your pension, you need to apply in advance. We rarely recommend 4 months. Once you actually submit your application for benefits, the fund office Retirement Benefits Department team will review that application for benefits, and we will send you out a written acknowledgement letter of receipt of the application, and we will tell you what additional documentation we still need from you, or what additional questions we have regarding the answers to your responses on the pension application. Okay. When you apply for benefits, you will need to submit documentation regarding several things. So we will need a copy of your county certified birth certificate. If you are married, we'll need a copy of your county certified marriage certificate. And we need a copy of a government issued photo ID for the retiree, for the carpenter, and if you are married, of the spouse. Usually people submit copies of their driver's licenses, but a passport would also be acceptable, or a state ID. So it's got to be a government issued photo ID. With respect to the birth certificate, copies are acceptable, but they have to be copies of the county certified birth certificate. So a lot of people have a little what's called a commemorative birth certificate. It came from the hospital. It's got cute little footprints on it, like they took imprints, ink imprints of your feet when you were born. That is not an acceptable proof of birth. Okay, it has to be the county certified birth certificate. The same thing with the marriage certificate. A copy is fine, but it has to be a copy of your county certified marriage certificate. A commemorative certificate from the church or the synagogue or the mosque or wherever you may have gotten married in a religious ceremony is not acceptable. It has to actually be a copy of the county certified marriage certificate. If you are going to make an appointment to come into the pension fund office to turn in your documents, if you bring your original documents with you, we will copy them in the fund office, and we will give your original documents back to you right there while you are in the fund office with us. You don't have to leave them with us or anything. You'll get them back that same day, but that means you won't have to go looking for a copy machine or making copies on your printer at home. Payments, your monthly pension payments are paid monthly on the first working day of the month. Mandatory direct deposit starts with your second pension payment. Okay. It does not start with your first payment. Your first payment is always a paper check. And that paper check is going to come out to you in a big white envelope with a lot of other things enclosed. We are legally required to send you a copy of the summary plan description, send you a copy of work restrictions, send you a copy of the appeals procedures. There are a lot of documents that the Department of Labor says that we have to furnish to you when you first become a pensioner. So we put those documents enclosed with your first pension check. And then when you're endorsing the first pension check, it's basically proof that we have that you also received all of those documents. Okay. We do not issue monthly pension check stubs. We do not mail out check stubs. But now payment details, as we discussed earlier in the presentation, payment details are available on the new participant portal. So you can log into the portal to see basically your check stub every individual month. You'll see your gross amount, your tax deductions, your retiree health benefit deductions. All of that is available on the participant portal. Part of your pension application is a federal tax form. Your monthly pension benefit is federally taxable. We talked about this earlier in the presentation. So you will need to fill out a federal tax withholding form to let us know whether or not we are to hold federal taxes from your pension check, or if you're going to handle those yourself with the IRS. If we are not withholding, you should talk to your tax advisor because you may need to file quarterly tax returns with the IRS. Again, we're not tax advisors, so please talk with your tax advisor. And then this last bullet is basically just everything I mentioned earlier. We are required to send out with your first pension check these different items that we have to send out to you. They are part of the handout packet, these federally required documents. In the handouts, in the pension handouts, they're pages about page 38 or 39 to page 44 or 45. They're right in that area of the handouts. benefit adjustments. So most of you have been carpenters for many years and you know how it works. Your employer is required to submit the employer contributions for the hours that you work this month by the 15th of next month. Okay. So the hours you work in any given month are due to the contributions department at the fund office by the 15th of the following month. We process pension a full month, if not probably more like 6 weeks ahead of time. So if you are working up until right before your pension starts, all of your hours are not going to be on file in the fund office before we do your initial pension calculation and process your first pension check. So what happens is approximately 3 or 4 months after your pension starts, the Retirement Benefits Department will automatically look for any additional hours that may have come in on your behalf to see if those additional hours generated any additional pension credit. If any additional pension credit was generated, and usually if this happens, it's like an additional quarter year or half year of credit, depending on the timing. The Retirement Benefits Department will recalculate your monthly pension to include those additional quarters, and we will process an adjustment to your monthly benefit, and we will give you any back money that we owe you for any pension checks that you already received. So for example, if you are starting pension in July, August, September, October, November, on or about your October or your November pension check, you want to watch and see if you see a little bit of a bump in your money on there. If so, it's because an additional quarter or half year or so came in on your behalf. Not only did we up the money that you're entitled to, but we also gave you the back money that we owe you for, July, August, September, for any months of checks that you already received before we processed the adjustment. It is also important to understand that the full adjustment for any additional quarters that come in once your pension is initially processed, that full adjustment is made to your monthly pension benefit, okay? We do not make an adjustment to the partial lump sum payment if indeed you've selected the partial lump sum payment. All of that money goes onto your monthly check. We do not send out like a supplemental lump sum check or anything like that. If indeed you are on pension and you are still doing some work, and our next section of the slides is talking about prohibited employment and what you can and can't do, in some cases, if you are 65 or 70 and a half and you're still working, you may still be receiving some contributions. Again, we'll talk about how in the next section. Okay. But we do an annual adjustment, a once-a-year adjustment for individuals who earn hours after their pension starts. And once a year, your pension gets adjusted for any additional credit that was earned in the prior year. That adjustment usually takes place in April, and it goes retroactive to January of that year. So, for example, you go on pension in 2022, and you're over 65 and you're working under what's called the 39-hour rule, and we will talk about the 39-hour rule in just a couple of slides. If you're working 39 hours a month, having contributions come in on your behalf, you have to be at least 65 to do this, okay? But if you're working 39 hours a month every month, by the end of the year, you're going to pick up an additional quarter year of credit that actually accrued to you after your pension started. So if that happens in 2022, in April of 2023, we will make an adjustment to your monthly pension amount for any extra 2022 credit you may have earned after your pension started. And that April adjustment is calculated for the April payment, but it goes retroactive to January 1st of 23. So on the April check, you'll see your money go up, plus you'll get back money for January, February, March of next year. So even on the pre-registration form where we had a section that said, is there anything else we should know about you? Several of you registered for the webinar today, put in some questions about prohibited employment and what type of employment is allowed while you're drawing your pension and what you need to do to start your pension, or actually what you need to stop doing in order to start your pension. So the plan rules comply with IRS regulations. And there's a two-part criteria under both the plan rules and the IRS regulations. So in order to start your pension, the first part of the two-part criteria is that you have to stop working in any capacity, with any employer who is signatory to the pension fund. And you must not have an intent to return to employment with any signatory employer. So if you're working for XYZ Construction Company, and if XYZ Construction is a contributing employer, it's not enough to just stop working with the tools for XYZ Construction. You have to stop working completely for any company that is signatory to the fund. So you can't even be a truck driver or a messenger for a signatory company. You have to completely stop working for a signatory employer and not intend to return to employment with a signatory employer. Okay. And then the second part of the requirement is that you cannot be working in any type of prohibited employment, whether or not that employment is with a signatory employer. If you stop working, do you have to apply for pension benefits right away? And the answer is no, you don't. You can stop working, but wait to apply and receive your pension benefits at a later date. So there has to be, the first bullet point back here is that you have to stop working for any signatory employer. And that cessation of work has to be what the IRS calls a legitimate severance of employment. And a legitimate severance of employment means you really and truly quit. You don't have any kind of a wink, wink, nudge, nudge agreement with the company that, oh yeah, I'm going to quit today, my boss Bob, I'm going to quit today. And my wife and I are going to go on vacation down to Florida for 3 months. And then when I come back from Florida, you're going to rehire me. Okay. That's not a legitimate severance of employment. You have to stop performing services for a signatory employer and have no intent of returning to work for a signatory employer. Okay. Not even in a capacity that you think is not prohibited employment. My example a moment ago was, being a truck driver or a messenger for a company. There is an exception to the severance of employment rule that says that if you are at least 65, you're at least normal retirement age, and if you are not performing prohibited work, and we're going to look at prohibited employment examples in another slide, if you are not performing prohibited work and you're at least 65, there does not have to be a severance of employment. So this severance of employment, the blue box on the top, number 1, that applies pre-65. Once you're 65, there doesn't necessarily have to be a severance of employment, provided that you're not working in a job that is considered to be prohibited. So let's talk about what it means to be working in a job that is prohibited. Prohibited employment means that employment, self-employment, or other business activity in the trade or craft of carpentry or other business activity covered by a CBA. Okay. So I know I just read the definition off the screen, but there's really not a better way to say it. Prior to age 65, you may not work in any of this type of employment in any geographic location. So it's not just here in the Chicago area or here in the jurisdiction of the Mid-America Carpenters. It's anywhere across the country that has a reciprocal agreement with the pension plan. And reciprocal agreements exist pretty much all across the country. So you cannot be working in prohibited employment in any geographic area pre-65. Once you reach 65, you can work in an occupation that is considered prohibited employment for less than 40 hours a month. It's called the 39-hour rule. So once you're 65, you can go back to work in the trades. You can use the tools. You can be working in a supervisory capacity, whatever you would like, but you are limited to less than 40 hours in any given month. Okay. So when we talked about disability pension, we talked about the fact that the fund office looks at how much money you make in addition to what type of work you're doing. For non-disability pensions, we are just looking at the type of work you're doing, and we're limiting the amount of hours you can work at prohibited employment. So pre-65, no hours at all. Between age 65 and 70 and a half, you're limited to less than 40 hours a month. And if you're interested in doing this, called the 39-hour rule, there is a one-time form that you need to complete and submit to the Retirement Benefits Department to let us know that you're going to be taking advantage of this 39-hour rule. It's in the handouts. It's page P49 in the pension handouts. Once you are 70 and a half or older, in accordance with federal regulations, you can work as much as you want in any capacity that you want, and you can still draw your pension without penalty. So once you are 70 and a half, working as much as you want. We probably have a dozen or so retirees, 70 and a half or older, who are still working, who still have contributions coming in on them. Now, I seriously doubt that they're actually, out there, working with the tools still, but maybe they're working in some type of a supervisory capacity. Okay. So I'm keeping half an eye on the questions. I don't see anything coming through yet, but let's talk about some prohibited employment examples. Okay. So it is prohibited to work with the tools. Any employer at all, union or non-union, signatory or non-signatory, you cannot be working with the tools. You can't work as a building inspector for a contractor. You can't be a superintendent, a supervisor. You can't be a project manager. Okay, a lot of questions come through about that. In fact, I'm pretty sure that on the pre-registration form, somebody actually specifically said, can I work as a project manager for a construction company? And the answer is no, that is considered prohibited employment. Now, once you're 70 and a half, that answer changes to yes, because once you're 70 and a half, there is no more prohibited employment. But pre-70 and a half, you can't be a project manager, supervisor, or superintendent. You can't be an employee of the council, of the benefit fund office, or of the apprentice and training program. You also cannot be a member of the e-board. You can't be a delegate to either the council or to the Chicago Federation of Labor. You can't be a business agent, a trustee, or an officer of any local union. Sometimes there's a question about you're a member of the e-board or you're a local union trustee. You can finish out your term while still drawing your pension. If you were elected prior to starting your pension, you can finish out your term, but you cannot run for re-election. Okay. Now, this example, this list is not all inclusive. We're giving you the most common examples, the most common questions we get. The green box on the right, things that are not considered prohibited employment. Well, there's tons and tons of things that are not prohibited employment. I mean, you can go drive a bus, you can sell shoes, you can go serve ice cream at Dairy Queen. There's many, many things that you can do that are not prohibited employment. But if you're talking about things that would be related to the trades, it is not prohibited employment to be a building inspector for a state or a county or a municipality. You can be the inspector who comes in and reviews someone's home prior to a home purchase or a home sale. You are allowed to do sales. So you can work at one of those big box hardware stores and you can sell lumber or you can sell cabinets or you can sell flooring, as long as you're not the person going out to install those cabinets or that flooring or anything like that. Okay. You can do picket duty. You can certainly volunteer. We have several retirees who volunteer for Habitat for Humanity. They're not getting paid, but they're utilizing skills and expertise that they learned as a carpenter for a very worthwhile charitable organization. Okay. It's okay to be a draftsman or work with computer-aided design. It's okay to be a safety director for a company, even for it's okay to be a safety director. As far as ownership, you can commence your pension benefits if you are a passive owner of a construction company, and that would be pre-65. So if you own your own construction company and you're actively involved in the management of that company, you cannot commence benefits until at least 65. A passive owner to start pension pre-65, if you're going to be a passive owner, basically that means, maybe it's a family business and the kids are now running the business here in the Chicago area, and you've moved out to Arizona or down to Florida or out to Montana or, wherever your heart desires, and you're fulfilling your idyllic retirement, and someone else is running the company here. You can still be the owner. But if you're actively involved in the running of that company, you cannot do that. That would be considered prohibited. You can be a corporate officer as long as you're not working with the tools. And it is okay to be a consultant regarding the viability of a project. If you are considering returning to work, or if you want a definite determination on a job, whether or not it would be considered prohibited before you start your pension, you should send a written job description, generally prepared by the employer on the employer's company letterhead. You send a written job description into the Retirement Benefits Department for review, and the Retirement Benefits Department will review that description and will respond to you in writing to let you know whether or not that job will be considered prohibited employment, whether or not it would cause a suspension of your pension if you're already receiving pension, or whether or not you would be able to start your pension benefit while still performing that particular type of work. Okay. That written description, it protects you and it protects the plan. And it's a really, really good idea for you to get a written job description, determination letter back from the plan, because 2 years down the line, we do some kind of an audit or review and we find out that you've been working all along, and you say, well, of course I've been working. I called the Retirement Benefits Department before I started my pension, and I talked to them about this job that I'm doing. And Jimmy down at the Retirement Benefits Department, or Susie down at the Retirement Benefits Department, said that this job is perfectly fine, so of course I'm still working. Well, it turns out maybe that you're doing something that we do consider prohibited. And we're going to tell you, okay, well, your pension is going to stop. We're going to suspend your pension benefit, and you're going to owe us money back for all of the months of pension that you received while you were employed in this manner. And you say, well, no, Jimmy and Susie said it was okay. And I say, okay, but there's no Jimmy and Susie working at the pension fund office. So I have no idea who you talked to. You have no proof of who you talked to. The written determination protects you and protects the plan together. So let's briefly talk about your supplemental retirement plan. Your personalized D like in David printout shows you your approximate John Hancock balance. When you are ready to retire, you can certainly withdraw your John Hancock retirement account, your supplemental retirement account balance, but you do not have to if you don't want to. Okay. If indeed you want to withdraw the balance from John Hancock, you're going to call John Hancock actually to request an application at the phone number on your screen, or through the John Hancock participant portal, you can also request withdrawal forms on the John Hancock participant portal. You do not have to withdraw your Hancock balance. You can leave that with John Hancock. You have to start taking what are called required minimum distributions And those required minimum distributions have to start the April of the calendar year after you reach age 72. Okay. It used to be 70 and a half, and it was increased to 72, I want to say about a year ago, maybe 2 years ago. So you don't have to take out the Hancock money if you don't want to. You will complete the application for a supplemental retirement plan withdrawal. You can either take a lump sum withdrawal or you can take installment payments. If you take a lump sum withdrawal, the taxability of that benefit works exactly the same as how we talked about the partial lump sum payment on the pension plan. So you can have your Hancock balance paid directly to you, whereby it becomes taxable income for the year in which you receive it. And John Hancock is required to hold back 20% to credit against your federal income taxes for the year. It's not necessarily that that benefit is taxable at 20%. It's taxable at your own personal income level. That's between you and the IRS. But Hancock will hold 20% if it's paid directly to you. You can also do a withdrawal from the supplemental retirement plan in a lump sum and roll that money into a traditional IRA or a Roth IRA at the financial institution of your choosing. In addition to lump sums, you can also elect installment payments. Installment payments can be monthly, quarterly, or annual installment payments. So you can elect to do installment payments on your supplemental retirement plan account if you like to. You might want to talk with a financial consultant to see what is best for you. I will tell you that the fees that you pay in your Hancock accounts and the investment options available under the Hancock plan, those fees are really low fees compared to industry standard fees. So while you're welcome to take that money out, you might want to think twice. You might want to investigate the fees available with John Hancock and the fees that might be available to you, through a different financial vehicle before you make your decision. And again, please remember, if you're going to leave your money in John Hancock, you certainly have the option of rolling your partial lump sum payment on the pension side directly into your John Hancock supplemental retirement account. Okay. The current contribution rate to John Hancock as of June of last year is $9 an hour on the construction side. I believe the majority of mill employers, it's $1.50 an hour, but there are many different mill collective bargaining agreements. So if you are a mill participant, you might want to check with the contributions department at the fund office if you're not certain how much per hour your mill employer CBA is actually requiring contributions to the supplemental retirement plan. I mentioned on this previous screen that you can register under John Hancock, My Plan for Retirement. These are just a couple screenshots of, on the left, the John Hancock website. You can certainly see your plan balance. There's some retirement calculators out there on the John Hancock website, not on the app on the phone, but on the actual computer website if you log in with a laptop or a desktop computer. There's some retirement calculators out there. There's a lot of tools that can assist you with financial planning for retirement. On the right-hand side, John Hancock has a new, I say new, it's maybe a year old or so, John Hancock's app, like for your phone. The old app was, quite frankly, it was really bad. You couldn't really do anything out there. It took a long time to load. You really couldn't do much except maybe see your plan balance. Their updated app, which is screenshotted for you there, you can get it either through the App Store or the Google Play Store. Their updated app is really nice. You can see your balance. You can log in on a daily basis and see how your balance has gone up or down. And then on this screenshot here, it shows this individual 60% prepared for retirement. We actually send a file to John Hancock of your accrued monthly benefit in the regular pension plan. So the John Hancock app and retirement calculators has on file already an approximate amount that you're going to draw from your defined benefit plan. So it takes your regular pension into account when it's using the tools to figure out your retirement preparedness. We update that with John Hancock about once a year. So the information John Hancock has right now is based on the $100 accrual rate in the construction plan, provided, of course, you haven't had a 3-year break in service. So that's out there. We will update with John Hancock probably later this year to the 125. Retiree health benefits. This slide's just an overview. We're going to talk about eligibility requirements. We're going to talk about what happens if you are still eligible for the active plan of benefits when you retire. We'll, of course, look at premiums. We'll talk about the situations in which you can postpone enrollment. We'll talk about coverage both before and after Medicare. We'll talk about some additional benefits that are available to you. And we'll talk about the Carpenter Center for Health and Vision. And we'll wrap it up with prescription drug benefits. Okay. So the first question is whether or not you are eligible for retiree health benefits. If you are eligible, the retiree health benefit forms will be provided to you by the Retirement Benefits Department at the same time you complete your pension application. Now, for those of you that are going to use today's handouts to actually apply for pension, the health benefit forms that are in the health benefits handout have the word sample printed across them. So you cannot actually use those health benefit forms. So once your pension application comes into the pension fund office, we will send out health benefit forms to you for completion. Or if once we go over the requirements, you think that you qualify for retiree health benefits, you can certainly give the Retirement Benefits Department a call, and we can email you or mail you if you prefer paper mail through the post office. We can mail you out in a set of actual forms that don't say sample across them that you can use for enrolling in the retiree health benefits. Okay. So in order to be eligible, in general, you need to have 10 years of eligibility service to be eligible for retiree benefits. And I'm going to bring up a couple of things here. So for most individuals, eligibility service is equivalent to vesting credit, provided that the employers that you worked for paid in to both the pension program and the health and welfare program. Eligibility service ends up being the same as vesting credit. So you can look at your A personalized printout with the A, the big A on the top right corner, and at the bottom of that, the totals show you how many years of vesting credit that you have. Okay, provided that your employers paid both pension and health and welfare, and you would know that because you should know whether or not you've had the carpenter's health benefits for however many years you've been a carpenter. You can use that vesting credit total for this presentation to look for eligibility and for the tiered premiums. Okay. So 10 years of eligibility service if you have never had a 3-year calculation break-in service. If at some time you had a calculation break-in service, so you had 3 or more consecutive calendar years without any pension credit, then the requirement is 15 years of eligibility service. 15 years of, most of you again can look at the vesting service total on your individual A credit printout that was in with your personalized packet of information. Okay. So what happens when you retire, whether and you still have active health benefits at the time of your retirement? So if you are not eligible, let's do it backwards. If you're not eligible for the active plan health benefits at the time your pension starts, and if you are eligible for and you enroll in the retiree health benefits, which the rest of this webinar is going to talk about the retiree health benefits, then your retiree health benefits will begin on your pension award date. So think back before the break, we were talking about now is the time to file for July and how sometimes your award date is different from your effective date. Health benefits never go retroactive, okay? If you apply at the end of June and you want your pension to start in July, we talked about maybe you'd be entitled to retroactive July pension money, but your retiree health benefits never go retroactive. So retiree health benefits start on your award date if you are not eligible for the active plan of benefits. Okay? So that's just another reason why if you need the retiree health benefits, you want to make sure that you're applying in advance, and our recommendation is 4 months in advance. If you are eligible for the active plan health coverage, then the coverage in the active plan will end when you fall below a total of 1,000 hours for the past 4 work quarters. Okay, and we're going to look at that on the next slide. But even though your pension starts, if you have enough hours, your active eligibility will still continue. So in many cases, when an individual's pension starts, even though they're considered a pensioner for the pension money, they still continue on the active plan of health benefits, usually for about 6 months after retirement, depending on how many hours the individual has worked. Okay. So if you are eligible for the active plan at the time your pension starts, that active coverage will maintain and will stay in place until you fall below 1,000 hours for the past 4 quarters. At that point, you have 2 options. Your first option would be that you move directly from the active benefits directly onto the retiree plan of benefits. Okay? You will still complete your enrollment forms at the time you complete your pension application, because the Retirement Benefits Department will code the computer system to indicate yes or no whether or not you want the retiree health benefits right after the active plan of benefits end, right after your hours run out and you fall below 1,000 hours for the past 4 quarters. Okay. This is what most people do, but depending on your individual situation, you may want to consider picking up continuation coverage under COBRA after the active benefits end before you move on to the retiree benefits. Now, sometimes people hear COBRA and they think, COBRA, what's COBRA? It's this mysterious word that nobody seems to really understand. So there is absolutely nothing mysterious about continuation coverage under COBRA. COBRA is simply an acronym, and it stands for the Consolidated Omnibus Budget Reconciliation Act, and that was passed back in 1985. So it's just a law. So what the COBRA law says is that when your active benefits are ending because you fall below 1,000 hours for the past 4 quarters, you have the opportunity to continue on the active benefits by paying for the active benefits. You pay a premium out of your pocket for the active benefits. And you can continue those active benefits. You can pay a premium for those same active benefits with COBRA, and you can do that for a maximum of 18 months. Once that 18-month period is over with, then you would still move on to the retiree benefits. So the question is whether you want to move directly from the active benefits onto the retiree benefits, or after the active benefits, if you want to pick up continuation coverage under the COBRA law for 18 months maximum, and then after that continuation coverage under COBRA, subsequently move on to the retiree benefits. So you make a choice between the two. Well, why would someone want to continue coverage under COBRA? The COBRA premiums are in the handout packet, the health benefit handout packet, and they're on page H4 of the health benefit handout. If you don't have that handy, I will tell you that COBRA continuation coverage for the active benefits costs $681 per person per month, $681 per person per month, if you are going to continue the full package of the active benefits, including dental and vision, medical, dental, and vision. COBRA continuation coverage without dental and vision costs $616 per person per month. Okay, and we're going to look at the retiree premiums on the next slide. So you want to compare your options. You know, somebody who's got a lot of years of eligibility service of vesting credit in, your retiree premiums are going to be relatively low. But someone who doesn't have so many years in, you know, your retiree premiums will be more. Also, COBRA may make sense for you if you're falling out of active eligibility, say toward the end of the year. You know, maybe you've already met your out-of-pocket deductible and your out-of-pocket maximum. Maybe the active plan is currently paying your claims at 100% for the balance of the calendar year because you've met your out-of-pocket max. Maybe it makes sense for you to do continuation on coverage under COBRA. Also, please note that continuation coverage under COBRA, it's 18 months maximum. If you want to move to COBRA before the retiree plan, you do not have to take the full 18 months. You could do COBRA for 2 months or for 4 months or for 6 months. Okay, so you can do COBRA for a lesser number of months before moving on to the retiree plan. If indeed you are someone who vested and who maybe is not currently working under the Mid-America Carpenters Pension Fund, under the Chicago Pension Fund, or you're not eligible for health benefits under the fund at this time, yes, you can pick up retiree coverage when your pension starts, provided that you meet the credit requirements that we discussed on a prior slide. So if you've been gone for a while, you will probably need 15 years of eligibility credit, of vesting credit, in order to be eligible for the retiree benefits. But you could come onto the retiree benefits when your pension starts, even if you are not eligible for the active benefits at the time your pension starts. So those are your two choices: active direct to retiree, active to COBRA to retiree. Now, the big question, and I'm sure everybody wants to know about, are the retiree premiums. Okay. So sometimes when we send out an initial pension packet, maybe someone has not investigated how much retiree premiums are going to cost them, and they get their first packet and they see these premiums for the first time. I kind of feel like it's sticker shock. Like especially those of you who have worked steadily as a carpenter and have steadily had the active working carpenter health benefit for years and years and years, you kind of forget how much health benefits cost. Okay. So the way this chart that I have up on the screen works is you're going to look for your number of years of eligibility service. And again, you want to look at your credit printout with the A on the top right, and you want to look for your years of vesting service on that credit printout. For most of you, the years of vesting service is going to be equivalent to years of eligibility service. So for someone who has 30 or more years of vesting service, eligibility service, the monthly premium for Blue Cross Blue Shield for someone who is not yet Medicare eligible, I'm going to actually use a marker on the screen here. So right now we're talking about individuals who are not yet Medicare eligible. Okay. For someone with 30 or more years of vesting service, the Blue Cross Blue Shield Major Medical is going to cost $187 per person per month. Okay. So it's a carpenter and a spouse, $187 times 2. If you still have dependent children who are eligible for coverage and not yet on Medicare, you'd also pay $187 for each child for each month. Okay. Once you become Medicare eligible, and it doesn't matter who becomes Medicare eligible first, it can either be the carpenter or it can be the surviving spouse. If one of the individuals, one or more of the individuals, is indeed Medicare eligible, then the Carpenter's Blue Cross Blue Shield will be a secondary payer to Medicare, and we will look at the coverage charts after we get through the premiums, okay? So I'll explain coverage after we get through the premiums. But if you or your spouse, or maybe even one of your children might happen to be disabled, if you are Medicare eligible, Medicare is your primary carrier, so therefore your Carpenter's Blue Cross Blue Shield will be a supplement to Medicare, and your Blue Cross Blue Shield Medicare supplement premium will only be $47 a month. Now that's for someone with 30 or more years of eligibility service, of vesting credit. Okay. For someone maybe who only has 10 years of eligibility service, you can see that the premiums are considerably more, $300 per person per month for the Blue Cross Blue Shield pre-Medicare, or $80 per person per month for the Medicare supplements. Okay. Prescription drug coverage is a separate election and a separate premium. So if you also want to include prescription drug coverage in your retiree health benefits, if you have 30 or more years of vesting service, eligibility service, prescription drug coverage costs you an additional $75 per person per month. Okay, so you're going to have to do a little bit of math here to figure out what your actual premiums will be. The coverages are independent elections, so you can choose Blue Cross Blue Shield without prescription drug coverage, or you can choose prescription drug coverage without Blue Cross Blue Shield coverage. I'm also going to switch over and make this a highlighter. So my example was a carpenter and a spouse, neither one Medicare eligible. I said your Blue Cross Blue Shield is 187 times 2. Well, maybe the carpenter is already Medicare eligible, so the carpenter's Blue Cross Blue Shield premium would be $47 a month, and then the spouse's Blue Cross Blue Shield would be the $187 a month. So it would be $187 plus $47 if one of you is Medicare eligible and one of you is not. The prescription drug coverage premium does not change once Medicare comes into play. So the prescription drug premium would still be $75 per person per month. If you had some years where you earned some construction credit and some Millman credit, it gets a little bit more complicated, and you want to give the fund office a call. So those are premiums for Blue Cross Blue Shield and prescription drug coverage. We're going to look at vision and dental in a minute. Okay. So first, know that your premiums must be deducted from your monthly pension payments. Okay. You can't just send a check to the pension fund office. We're going to deduct your premium payments from your monthly pension check. Okay. I already mentioned this, that Blue Cross Blue Shield and prescription drug coverage are separate options with separate premiums. Dental and vision coverage are additional and separate, and the next slide has dental and vision premiums on it. The premiums are subject to change. However, I want to just mention that your board of trustees knows that how much you need to pay for your retiree health benefits directly impacts your standard of living once you move into retirement and you have your pension as your source of income. So the premiums on your screen have not changed since 2011, okay? So they've been the same for 11 years. So the Board of Trustees does not raise premiums lightly. They do everything in their power that they can to try not to raise premiums. In the premium history of the plan, these premiums started in 2011. Prior to this increase that happened in 2011, and in fact 2011 is when we moved to this tiered premium structure, the prior increase before that was back in 2006, and the prior increase before that was actually back in 2000. So it's not at least not currently, an every year occurrence where the premiums could change. That said, the trustees do evaluate these things on an annual basis to see what they can still sustain. These premiums are actually highly subsidized by the active working carpenter hours. I'm doing this from memory today because I don't have this note with me, unfortunately, but I believe that if you are at the 30-year eligibility tier, that your premiums are subsidized by the active working hours to the tune of something like 70%. And even if you only have 10 years of eligibility service, these premiums are subsidized by about 40% by the active working hours that are coming into the plan. Overall, the premiums that are collected through the pension checks, the premiums that the Retirement Benefits Department collects, only cover about, I want to say, 35% or so of the actual claim cost for the retirees. So the pension fund, the welfare fund, the health, now renamed the health fund, does not profit off of these in any way, shape, or form. So I urge you and encourage you to go out there on the marketplace and see what's available and what those premiums are, because I think if you do that, you're going to find that these premiums are extremely reasonable, very competitive premiums. In fact, they're probably going to blow the premiums you can find through other coverage away when you consider the benefit coverage, which we will talk about in just a moment. These benefits are very similar to your active working carpenter benefits. And I doubt you will find anywhere on the marketplace, premiums available that are this inexpensive. Okay, back on the slide, on the left-hand side of the slide, I just brought up another point. The retiree, the carpenter, must have coverage before the spouse or dependent can take coverage. So the carpenter has to have Blue Cross Blue Shield in order for the spouse to enroll in Blue Cross Blue Shield, the spouse or the kids to enroll in Blue Cross Blue Shield. The carpenter has to have prescription drug coverage in order for the spouse or the kids to enroll in prescription drug coverage. Even on the next slides, we'll look at vision and dental. The carpenter has to pick up dental in order for the spouse and the kids to have dental. The carpenter has to pick up vision in order for the spouse and or the kids to enroll in vision. The one sort of explanation I would like to make to that is that these two columns here where we're talking about Blue Cross Blue Shield, both pre-Medicare and post-Medicare, if the carpenter has one or the other of these, and if the spouse is the opposite, so the carpenter is not Medicare eligible, but the spouse is, that's okay. This is still Blue Cross Blue Shield. As long as the carpenter has one of these, the spouse can be enrolled in the Blue Cross Blue Shield, even if the spouse's Medicare status is the opposite of the carpenter's Medicare status. Dependent children can still be covered up to 26, just like on your active plan of benefits. And if you have a disabled dependent child, that disabled dependent child may still be eligible to keep coverage past age 26. There are forms to be completed for the doctor, the dependent child's doctor, to certify disability. And then we'll also look at whether or not that dependent child, disabled child after age 26 is still dependent on you, the carpenter, for a percentage of his or her support. I believe it's more than 50% of their financial support is also a requirement. But give the fund office a call if you have additional questions on that. Medicare, and this, I believe I've spoken to this already, Medicare eligibility is on an individual basis. The retiree and the spouse may have different Blue Cross Blue Shield coverage depending on your age and your Medicare status. And the retiree Blue Cross Blue Shield, just like your active Blue Cross Blue Shield, is a PPO plan. Okay, so it's not an HMO or anything like that. It's a PPO plan, just like you've had under the active plan. So if you're moving from your active plan to your retiree plan, you're going to be able to keep your same providers. Okay. So dental and vision coverage, separate premium. Okay. Dental coverage, now this works a little bit different. It's not per person per month. Dental coverage, if only one individual, if only the carpenter is covered, dental is $44.53 a month. If there are two people covered, and that could be a carpenter and a spouse, or a carpenter and one dependent child, okay, it doesn't necessarily only have to be a carpenter and a spouse if the spouse doesn't need dental, or maybe you don't have a spouse. If two people are covered, it's $86.42 a month. And then family coverage premium applies if there are 3 or more individuals enrolling in dental. Vision is a separate premium also. If only the carpenter is enrolled, it's $6.20 a month. If two people are enrolled, it's $11.96 a month. And if 3 or more people are enrolled, it's $18.22 a month. Okay, this next section is only pertaining to vision and dental. Only for vision and dental is there open enrollments. Okay, we'll talk about how you can postpone Blue Cross Blue Shield and prescription and pick those up at a later date. But give me a minute, let's get through vision and dental first. On the vision and dental, there is open enrollment annually, January 1st through March 15th, with coverage starting April 1st. So if you do not pick up vision and dental at the time your pension starts, you could add vision and dental later on during open enrollment. Okay. However, even with vision and dental, the carpenter, the retiree, must be enrolled in order for the spouse or the dependent children to be enrolled. Also, if you pick up dental or vision, and if you have services, and then if you cancel coverage as soon as you've had your services, you cannot re-enroll during the open enrollment period until you've been out of coverage, until you've been canceled for 2 full years. Okay, so there is open enrollment for dental and vision. There's no open enrollment for Blue Cross Blue Shield and prescription drug, but we will talk about postponing coverage for the Blue Cross Blue Shield and the prescription in just a moment. So out of the enrollment packet for the health benefits, out of the handout packet for the health benefits, there are sample enrollment forms on pages H7 through H12. And this is what an enrollment form looks like, or part of an enrollment form looks like. And I bring this out here as an example so that it's easy for you to see that the Blue Cross Blue Shield, here are the circles, this comprehensive medical benefits, that's Blue Cross Blue Shield. That is a separate choice from prescription drug coverage. The prescription drug coverage is the squares. And that is a separate choice from dental, which are the diamonds. And that is a separate choice here from vision. Okay, so all 4, Blue Cross Blue Shield, prescription, dental, and vision, they are independent elections. Okay. In order for the spouse or dependent children to be covered under any one of these categories, the carpenter must enroll in that category, in the Blue Cross, in the prescription, in the dental, or in the vision. But there are separate elections on the election form. There's a separate section in the form. This section here on my example on the slide is only the election form for the participant. There's another election section. See here, it highlighted in pink, it says participant. There's another election section on the forms for a spouse. And there are separate election forms for each dependent child, younger than 26 or perhaps older than 26 if they're disabled. So even if the carpenter is enrolling in all 4 of the categories, all 4 of the coverages, perhaps the spouse only wants the prescription coverage, or perhaps one of the children only wants the vision coverage, or maybe the spouse works outside the home and has coverage with the spouse's employer for Blue Cross Blue Shield and prescription, or for another medical plan and a prescription plan, but maybe the spouse doesn't have dental and vision. So as long as the carpenter takes the dental and the vision, the spouse can choose to only enroll in the dental and the vision, if that's what suits your individual situation. The Blue Cross Blue Shield PPO network is nationwide, as is Express Scripts for prescription. Delta Dental does the dental coverage, and VSP does vision coverage. So you can certainly use these benefits out of state. The only thing I would say is that if you are having services in another state, maybe you're out in New York or Arizona or California, when you go to your provider, make sure your provider knows that you have Blue Cross Blue Shield of Illinois so that your provider bills properly. That should be evident to the provider by your group numbers, your group codes, the information on your card, but it certainly would not hurt to point out to an out-of-state provider that you are with Blue Cross Blue Shield of Illinois specifically for the Blue Cross benefit. The prescription, dental, and vision shouldn't matter because those networks just process out of one central place. So what happens if you do not elect retiree health benefit coverage at the time of retirement? So I already talked about if you don't take vision or dental, you can enroll in those coverages during the open enrollment period annually. But what if you don't take the Blue Cross Blue Shield, or what if you don't take the prescription drug coverage? Okay, so you can postpone coverage under the retiree plan, provided that you and any of your dependents that you might want to enroll in the retiree plan at a later date, you have to have continuous coverage with another health care plan. So if you don't take coverage at the time your pension starts, maybe because you've got other coverage with another health benefit provider, say for 2 years, at the 2-year mark, when your coverage with your other provider ends and you want to come onto the retiree health benefit coverage at that time, you can do so, but you will be required to provide us with proof of what's called continuous coverage, continuous creditable coverage, really. The retiree health benefits must begin immediately following the termination of coverage under the other health care plan. Okay. And you need to request and return enrollment forms to the fund office at least 30 days before the coverage with the other plan will stop. It will be your responsibility to provide proof of continuous coverage with another health plan, with another insurance plan, when you want to come on to the retiree plan. So you want to make sure that you keep your annual 1095B forms, the tax forms that the insurance companies need to send out to you to prove that you've had other coverage, or make sure that the other plan will provide you with what's called a certificate of creditable coverage, or fill out forms that we in the Retirement Benefits Department have for another insurance company to fill out in order to verify continuous coverage with another plan. So here on this slide at the end of the first bullet point, it says 105-day gap rule applies. So the 105-day gap rule talks about an allowance, sort of a special allowance for a gap in coverage. I said that coverage has to be continuous, and in general, that is our expectation, that coverage will be continuous through another health provider if you're postponing our coverage. But for example, say you're covered under your spouse's employer insurance. So you postpone the retiree health benefits, and your spouse is working, and your spouse works maybe 3, 4, 5 years, after you actually retire. At some point in time, perhaps your spouse changes jobs, and your spouse's coverage through her first employer or his first employer ends 1 month, and then the spouse gets a new job, and the new job's insurance doesn't maybe pick up for 2 months, for 60 days, or maybe for 90 days. So there is a plan provision to allow for these, maybe job changes or insurance changes. 105 days is just slightly more than 3 months, really. So it allows over time, over the however long your postponement period is, to have a maximum of 105 days without other coverage. And the expectation is that 105 days, maybe your spouse changes jobs twice. So maybe one time there's a 30-day gap where you didn't have coverage because of a job change. And then there's a second job change a year or two later, and there's a 60-day gap there. Okay. At the spouse's final employment, when the final employment is ending or when your final coverage is ending, at that point in time, there cannot be a gap between the last outside coverage and the carpenter retiree health benefit coverage starting. So the 105-day gap is really talking about gaps in coverage due to job changes. It actually originally was not written into the plan, and there was an appeal where this situation actually happened to a family, and the trustees amended the plan to be a little bit lenient to allow for some days without coverage, without continuous coverage, maybe due to job changes. Effective in 2019, effective in January of 2019, surviving spouses can now continue health benefits following the death of the carpenter at the same premiums paid by the retiree, as long as the surviving spouse does not remarry. So this is a little bit different from the pension money, from the pension estimates, the monthly pension amounts that we talked about, okay? On the monthly pension benefits, if you take a 50%, 75%, or 100% pension payment option, that monthly pension money is for a surviving spouse as long as a surviving spouse lives and regardless of whether or not a surviving spouse remarries. And that is still absolutely true of the pension money, but it's different with the health benefits. If a surviving spouse subsequently remarries, although that surviving spouse keeps the pension money, the retiree health benefits end upon remarriage. What if you elect the single life annuity with the 60-month guarantee? What if you don't take a joint and survivor benefits? Okay, your surviving spouse still can continue the health benefits following the carpenter's death, but the surviving spouse will have to submit health benefit premiums to the fund office to pay for the retiree health benefit coverage. So that's the exception to the we have to take money out of your pension check. Well, we have to take the premium out of your pension check. Well, if you don't have a pension check for us to deduct a premium, then logic would dictate that you would have to pay your premiums by submitting premiums to us. We are actually currently working on some new programming right now, surviving spouses in this situation, and we have about 250 of them that are on the coverage since it became possible in 2019. Right now, those 250 spouses either have to send us a check or money order every month, or they have to actually go online each individual month and make a payment debited out of their bank account. We're working on some new programming that will allow us to automatically debit bank accounts every month for the premiums so that the surviving spouses won't have to worry about remitting premium payments to us if they do not get a monthly pension check following the death of the carpenter. So let's move on and talk about the actual coverage. Okay. So within the handouts, the health benefit handout, this brochure called Getting Ready to Retire starts on page H13, and it's maybe 10 pages or so, and it's a super nice, concise summary of the benefits under the retiree plan that exist without you having to read the summary plan description book, which is like 130 pages long. So this retiree health benefit brochure that's part of the handouts, or if you call for a pension application packet, this brochure is always part of the pension application packet. So if you're looking for something to reference or to have a kind of a quick read as opposed to, a 100-page book, this little 10-page brochure is really nice for the retiree health benefit coverage. As we start to talk about coverage, just like I said to you when we were talking about the lump sum, and I said, please, the partial lump sum, I said, please pay attention. This isn't necessarily taxable at 20%. Okay, this is my please pay attention to this. If you are actively eligible, for active working carpenter benefits right now, Know that the active plan deductibles or out-of-pocket maximums do not carry over from the active plan onto the retiree plan. Okay, so if you have met your active plan deductible, maybe January, February, March, and you're retired and you still have the active coverage all the way up until September 1st, once September 1st rolls around and you move from the retiree plan, from the active plan to the retiree plan, when your active benefits end and you move from the active plan to the retiree plan, you will have to meet a new deductible and work on a new out-of-pocket maximum. So they're two separate plans, the active plan and the retiree plan, and those deductibles and out-of-pocket maxes do not carry over. This is something that is frequently understood, and I really like to emphasize it during the seminars. Okay. If you are currently covered under the active plan, you have a network called Absolute Solutions for radiology or for imaging services. And that network, and if you use Absolute Solutions, your x-rays and your imaging services, your CAT scans, your MRIs, things like that, they're covered at 100% through Absolute Solutions. That network is not part of the retiree health benefit plan. That does not mean that your x-rays or your MRIs or CAT scans aren't covered. They absolutely are covered under the retiree through Blue Cross Blue Shield, but they are subject to your deductible and your co-payments. So they're going to be covered at 80% after your deductible. Okay, and we'll look at deductible and co-payments. So just know that that Absolute Solutions doesn't move to the retirees. Currently, if you're actively eligible, you are used to calling the fund office with questions about your claims or your coverage. Okay. Once you move on to the retiree plan, Blue Cross Blue Shield of Illinois will be your new contact to ask about claims payment and coverage. Okay. You won't be calling the fund office to say, I need to check to see if my doctor bill is going to be paid or if this service is covered. You're going to be calling Blue Cross Blue Shield. Chicago Carpenters or Mid-America Carpenters now, we have a dedicated phone number, a dedicated service team at Blue Cross Blue Shield. So you'll be calling into a specific group at Blue Cross Blue Shield who knows our retiree benefits and can answer those questions for you. So you'll be calling Blue Cross Blue Shield for information about claims and coverage. But if you have questions about your premium or about adding coverage or about dropping coverage, so premiums and coverage changes, those questions do still come to the fund office, but they will come to the retirement benefits department instead of the health benefits department. Okay, the health benefits department at the fund office exclusively works with the active plan of benefits, whereas the retirement benefits department at the fund office, we deal with both pension and the retiree health benefit premiums and enrollment. So just your contact information changes just a little bit. Just something important to know because, once in a while somebody will say, oh, I didn't know I had to call Blue Cross. I didn't know I couldn't keep calling you guys. So that changes a little bit. So let's talk about coverage, Blue Cross Blue Shield coverage under the retiree plan for individuals who are not yet Medicare eligible. So for individuals who are not yet Medicare eligible, your coverage is extremely similar to the active plan Blue Cross Blue Shield coverage, or maybe right now you're not covered by the active plan, so let's look at that coverage. It is a Blue Cross PPO plan, okay? As long as you are using a PPO provider, you have a $300 deductible per person per year. If it's just the carpenter and the spouse, then each of you have a $300 deductible for $600 total. If you maybe still have dependent children younger than 26 or disabled and older than 26, there's also a $300 family out of pocket. So once three people have met, family deductible, not out of pocket. Once three people have met their annual deductible, the deductible for the family is satisfied. So our Blue Cross plan is a PPO plan. You do have the option of going out of network to a non-PPO provider, but it's going to cost you. You have a separate additional deductible of an additional $600 for if you're using a non-PPO provider. Okay. Your coverage and co-payments, if you are using a PPO provider, you have 80% coverage. The plan is going to pay 80%, and you are going to be responsible for the other 20% of the Blue Cross Blue Shield discounted rate. Because if you're using a PPO provider, before you even get charged a deductible or a co-payment, the provider's agreement with Blue Cross Blue Shield discounts the amount of the service. So that's certainly a savings to you and to the plan. So as long as you're using a PPO provider, you have 80% coverage, you're responsible for the other 20. A non-PPO provider, you only have 60% coverage of the reasonable and customary or usual and customary service charge. And you are responsible for 40% plus any charges that are over and above the usual and customary, or some people call it reasonable and customary allowance. Okay. Your annual coinsurance maximum, again, this is pre-Medicare, is $2,000 per person or $4,000 for the family. Non-PPO would be an additional coinsurance maximum of $6,000. So once you reach your coinsurance maximum, some people call it an out-of-pocket maximum, coverage under the plan goes up to 100%. So instead of this 80-20 coverage, once you've met your annual coinsurance, so per person it's really $2,300. It's $2,000 for the coinsurance and $300 for the deductible. So once you've paid $2,300 out of pocket within any given calendar year, coverage by the plan goes up to 100% for the balance of that calendar year. Again, if you are currently eligible under the active plan of benefits, many of you registered today were, this works the same way under the active plan of benefits. So it's exactly what you're used to. Okay. Emergency room copayment, you have a $250 copayment for the emergency room if you are treated and released from the emergency room. If you are admitted to the hospital from the emergency room or within 72 hours for that same condition, that $250 emergency copayment is waived. Okay, so you don't have to pay that. It's waived if you're admitted to the hospital directly from the emergency room. In all cases, and for individuals currently covered by the active plan, and I realize some of you registered today are not currently eligible under the active plan, but these coverages still apply to you. If you are covered by the active plan, you also have your HRA card, okay, it was Connect Your Care and now it's Optum Financial, so you have your little Visa debit card. If you have a balance on that card, once you move to the retiree plan, provided that you are still a member in good standing with your local, you can use up any balance that you might have on that HRA card to meet these deductibles and these co-payments. Okay, so you still have to be a member in good standing with your local. That means your dues are current, your dues are not in arrears, but you can continue to use that HRA card under the retiree plan of benefits. Okay. So this is the pre-Medicare coverage in a nutshell on one slide. It's not terribly complicated. $300 deductible, $2,000 out-of-pocket max, 80-20 coverage at a PPO provider. Stick with those PPO providers. Most people use the PPO providers under both plans of benefits. It makes sense for you and it makes sense for the plan. If you are Medicare eligible, meaning age 65 at the time your pension starts, or perhaps you are covered under the pre-Medicare plan that we just talked about on the other slide. Maybe you're covered by the pre-Medicare plan for a couple of years after you retire or several months after you retire, and then you become Medicare eligible. Once you turn 65, Medicare will become your primary carrier. Okay, William, I see your question. Give me a minute. Once you turn 65, Medicare will become your primary carrier, and your Carpenters Blue Cross Blue Shield will become a secondary payer to the Medicare. Okay, so I find that a lot of people aren't really sure about exactly what Medicare is or what Medicare covers. It's kind of like that COBRA law we talked about a little earlier. It's kind of like this mysterious thing that people don't necessarily understand. So let's just do a quick basic overview of Medicare. There are two parts to Medicare, Medicare Part A and Medicare Part B. Medicare Part A is the part of Medicare that pays the hospital facility charges. So the room charges, the operating room charges at the hospital, your nursing care, your meals while you're in the hospital. Okay, that's all under Medicare Part A. Medicare Part B is the part of Medicare that pays the professional fees, the doctor's office visit charge, or even if you're in the hospital, what the surgeon's professional fee is to actually do the surgery. It covers lab tests, the reading of lab tests, the pathologist or the radiologist. Okay, so that's the basic difference between Medicare Part A and Part B. You can think of Medicare Part A as the hospital part and Medicare Part B really as the professional fee part, the doctor part. Well, what happens with your Carpenter Medicare supplement? Because you will move on to the Carpenter Medicare supplement once you are Medicare eligible. Well, first and foremost, you need to make sure that you have both Medicare Part A and Medicare Part B. So you need the Medicare hospital part and you need the Medicare professional fee part. Your Medicare premium is usually deducted from your Social Security check, not from your pension check, but from your Social Security check. Okay. The Medicare Part A, the hospital part, is free for most people. Okay. You have to have I believe it's 10 years, 40 credits, 40 quarters of work history in order to be eligible for the free Medicare Part A. And if you're a spouse, maybe who has not worked outside the home, that for you, that coverage plays off of your spouse's work record. And most people have had 10 years of work history. Okay. So the Medicare Part A for, I would say 99% of people, maybe 98% of people, is free. The Medicare Part B, the doctor part, the professional fees, you are going to be charged a premium for the Medicare Part B from Social Security. And for 2022, the Medicare Part B premium for individuals new to Medicare is $170.10 a month. Okay, but remember, your premium on the Carpenter's Blue Cross Blue Shield will go down. Okay, if you think back to this slide that we had where we looked at the tiered premiums, okay, and I don't want to flip back through all the slides, but if you think back to that, I showed you that the per person per month premium for someone who is not on Medicare, so Blue Cross Blue Shield for someone with 30 years of eligibility credit, Blue Cross Blue Shield is $187 a month. But once that individual becomes Medicare eligible, the premium from the plan, the $187 goes away, and you start paying $47 a month for the Medicare supplement Blue Cross Blue Shield. So you get $140 a month back on your pension check, $140 a month less that you're paying to the pension fund for the Carpenter's Blue Cross Blue Shield, because we're no longer your primary Blue Cross Blue Shield. We're just a secondary payer to Medicare. So although you're going to start paying Medicare for the Medicare Part B, you will have some additional money back in your pocket because you won't be paying the Carpenter's health plan quite as much. So we talked about Medicare premiums. What's the coverage once you're Medicare eligible? Between the Carpenter's plan and the Medicare plan, you have excellent coverage. Okay. Medicare is going to pay for your hospital facility charges. So if you are admitted to a hospital facility, Medicare Part A, remember Part A is the hospital part, there is a $1,556 deductible on the Medicare Part A when you're admitted to the hospital, but your Carpenter's Blue Cross Blue Shield Medicare supplement pays this copayment. Okay. That pays for the first 60 days of care. So one deductible of $1,556 charged by Medicare and covered by your retiree Blue Cross Blue Shield Medicare supplement handles your first 60 days of hospital care. In the rare event that you are in the hospital longer than 60 days, Medicare requires a daily copayment of $389. Your Carpenter's Blue Cross Blue Shield Medicare supplement pays that $389 Medicare copayment. Okay. On the Medicare Part B, the doctor part, the professional fees, you have a Medicare deductible of $233 that needs to be paid before Medicare covers anything. Your Carpenter's Medicare supplement pays that Medicare Part B deductible, so you are not responsible for that. Once that deductible is met, Medicare is going to pay 80% of the remaining professional fees, and your Carpenter's plan is going to pay 20% of most Medicare approved expenses after Medicare pays. Okay. Now I say most Medicare approved expenses. There are a couple, not very many at all, things that the plan doesn't cover that Medicare covers in certain situations. Somebody's going to ask what? The only example that I can think of is it will pay for gender transition surgery. Medicare pays for gender transition surgery in certain circumstances, and your Carpenter's supplement plan will not cover the secondary charges, will not supplement Medicare for that. That is the only thing off the top of my head that I can think of that Medicare covers that the plan doesn't. This is an excellent Medicare supplement. Again, just like I talked about when we talked on the premium pages about the pre-Medicare coverage, you are most welcome to shop around for coverage. There is nothing at all that says you have to keep the Carpenter's coverage, okay? But I think you're going to find that it's a little bit tough to beat the Carpenter coverages and premiums if you shop around on the marketplace. Well, in general, you pick up Medicare when you're 65. However, if you are still eligible for the active working Carpenter plan of benefits at the time you reach 65, you can postpone enrolling in Medicare so that you don't have to pay that Medicare Part B premium. And you can postpone enrolling in Medicare until 8 months after the earlier of you stop working or your active health benefit plan ends. It's called a Medicare Special Enrollment Period, SEP, Medicare Special Enrollment Period, and it's the 8-month period that starts the clock ticking as of the earlier of when you stop working or when your active benefits end. So if you have questions about that, because it's a little bit difficult to follow and I don't have a separate slide on it, please give the Retirement Benefits Department a call and we can talk with you, or even give Medicare a call to talk with them about the special enrollment period if you are already 65 or older than 65 and still covered by the active plan of benefits. Some additional benefits covered. Under the Retiree Blue Cross Blue Shield, you have chiro, acupuncture, and napapathy care. There are annual maximums of 50 visits for the retiree, 30 for the spouse, and 15 combined visits for dependent children aged 12 and older. So that's a combination of chiro, acupuncture, or napapathy care limits. You also have a hearing benefit through the Epic Hearing Network. And a hearing exam is covered at 100%, up to $150 every 2 years. And hearing aids, this was a significant benefit improvement about 2 years ago. Hearing aids used to just be covered at $1,000 on the retiree plan, and hearing aids are now covered at $5,000 once every 5 years. To be eligible for these additional benefits, you must be enrolled in the Carpenter's Blue Cross Blue Shield, either pre-Medicare or Medicare supplement. If you elect not to enroll in the Carpenter's Blue Cross Blue Shield, you will not have these additional benefits. Okay. Also, you have a new benefit as of January of this year, Lyra Health, care for emotional needs. You can talk to a counselor, a therapist, help when you need it. The active plan had mental health coverage, these what they call member assistance programs or employee assistance sessions. The active plan of benefits has had that for a long time, but it was just added to the retiree plan as of January of this year. So you have 12 free sessions a year. You can talk with a counselor in person or over the phone or on a video visit. Something to consider. And then retirees do have life insurance prior to age 65. So if you are covered under the Retiree Blue Cross Blue Shield, there is a $25,000 life insurance policy for the carpenter, for the participant, and that is through Hartford. Okay, but that policy is only in effect if the carpenter passes away before the carpenter reaches their 65th birthday. Once you reach age 65, this coverage provided through the retiree plan of health benefits does go away. You can convert it to an individual self-pay policy directly through Hartford, just like you can under the active plan of benefits. So for these 4 additional benefits, the 2 on the last slide and these 2, please remember you have to be enrolled in the Retiree Blue Cross and Blue Shield, either pre or post Medicare coverage. Out at our Lisle campus, many of you are familiar with the Lisle campus. Most of the local unions are located out there. You have your Carpenter Center for Health. As long as you are enrolled in the Blue Cross Blue Shield retiree plan, either pre or post Medicare, you can use the Carpenter Center for Health. And as long as you elect to pick up vision coverage, you can use the Carpenter Center for Vision out at the Lisle campus. Prescription drug benefits are provided through Express Scripts. Again, this is exactly the same as the active plan of benefits. Long-term medications, also called maintenance medications, your blood pressure pill, your diabetes medication, your cholesterol medication, those long-term types medications can only be filled at a retail pharmacy 3 times. After 3 times, you have to move to the Express Scripts mail order program, or new as of last year, you can get a 90-day supply at a pharmacy, but it has to be a Walgreens pharmacy. So being able to get a 90-day supply at a Walgreens pharmacy, is new as of last year. So prescription drug co-payments, same as the active plan of benefits. If you're getting a generic filled for a 30-day supply at retail, $5. Home delivery for a 90-day supply or a 90-day supply through Walgreens is $12.50 for a generic. A single source brand, when there is no generic, is a 20% co-payment at retail with a $10 minimum, $100 max. 20% co-payment on home delivery for a 90-day supply or at Walgreens for a 90-day supply with a $25 minimum and a $250 max. Multi-source brand, there is a generic available, but you or your doctor, for any reason, don't take the generic, your coverage is a bit more expensive. You have a 35% co-payment, a 35% out of pocket with $20 minimum at retail or $50 minimum through mail order or Walgreens for a 90-day supply. Accredo is your specialty drugs. Specialty drugs are usually injectable drugs that require some type of a special handling. They're used for many different things, but some things would be for cancer treatment, for multiple sclerosis, for hepatitis B. Specialty drugs must be obtained through the Accredo Specialty Pharmacy, which is a mail order delivery program. You have a 20% co-payment on a 30-day supply with a $20 minimum and a $100 maximum. So saying $100 maximum on a 30-day supply of something, it kind of sounds like a lot. In fact, I know it sounds like a lot, but specialty drugs are generally extremely expensive. There's one particular specialty medication that's used in the treatment of hepatitis C that costs $3,000 a day. So specialty drugs are extremely expensive injectables, and generics are not available for them. Union dues. A couple of times people have typed questions about union dues. So you want to talk to your local union about the benefits of keeping up your retiree dues. We certainly encourage you to do so. As long as you pay your union dues and you remain a member in good standing, you can use up any balance in your HRA account. That's your debit card through Optum. And you can also take advantage of the Midwest Coalition of Labor Members Only Benefits. And the Members Only Benefits brochure is one of the handouts for today's presentation.